Good morning and welcome to Morningstar's UK Investment Conference for 2021, our 15th annual conference. So whether this is your first time or you're a multi-year veteran, welcome to you all. I'm standing here in a TV studio, so like you, I'm going to miss the face-to-face interaction. But a twist of fate means we've actually got greater reach than ever, more advisors attending than ever before, and we've been busy behind the scenes to ensure you really get the most from your time with us. There's a topical agenda, software for you to seamlessly navigate through the conference, and a whole host of ways for you to make this as interactive as possible. For starters, there's delegate questions. In most of the sessions, you will have the chance to ask the speakers some questions. On the left-hand side of the session window, you'll see a number of tabs. Under the question mark icon, you can pose your questions, which the moderator will pick up. Then under the other icons, you can see information about the session and any other documents related to it, including any slides. Then there's virtual stands. For the Morningstar stand, visit the Morningstar tab on the navigation at the very top of your screen, where you can meet with our teams, see what's new, and ask your questions of our subject matter experts. For sponsor stands, please also take some time over the next 2 days to visit our sponsors in the exhibit hall. There's a whole host of information for you to take a look at, as well as sessions from our principal and lead sponsors, all hosted from their stands. So at this point, we'd like to thank our sponsors: JP Morgan Asset Management, Baillie Gifford, M&G, Nikko Asset Management, Fidelity, PIMCO, Jupiter Asset Management, and Schroders. PIMFA and Octo have acted as conference supporters. Then we have our media sponsors, Investment Week and Professional Advisor. Before we move on, you can't forget CPD, where your points are allocated based on your viewing time. We top this up, and it's up to a maximum of 6.5 hours. All the content from the conference will be made available on the platform for you to watch at leisure between now and the 1st of December. After that date, we'll send you your CPD certificates. So that's the housekeeping out the way. And now the virtual stage will be taken by Morningstar CEO Kunal Kapoor.
Good morning, everybody, and welcome to the Morningstar Investment Conference. Thank you for joining us today virtually. We're so excited and looking forward to the day when we can have all of you back here in person. But certainly, we've learned a lot of good lessons in the past 18 months about how to bring the best of an in-person and a virtual experience to you, and our conferences in the future will certainly hold the best of both worlds. I hope in the past 18 months you and your families have been safe, and it's nice that no matter what, we're here today talking investment topics, something to get the mind off and focused on the path ahead. You may be aware that this is in fact the 15th anniversary of our conference in the UK. 15 years ago, there was in fact a football World Cup going on with England playing Sweden right around the time of the conference, and that summer, Europe was enveloped in a heat wave. You can draw plenty of parallels, actually, between 15 years ago and today that go beyond sports and the weather. Most notably, 15 years ago, housing prices in the US had started to show signs of cracking, and that was the first sign of an impending global financial meltdown that followed. Fast forward to today and think about what we've been through in recent times with the pandemic as a background. Isn't it amazing that despite the pandemic, the economic outcome that we appear to be facing is quite different and not nearly as catastrophic as what happened at that time? But certainly, there's lots of questions to be answered, including at this conference, around the gaps between the haves and the have-nots and what that means in the context of all of us doing our work. The good news is that real or perceived barriers to investing are falling away, and more people are deciding that they want to be investors. Fees are falling sometimes to zero. You have the rise of fractional share trading and democratized access to data, research, and insights. Technology firms like Morningstar, and in the UK, other firms like eToro and Nutmeg are enabling more and more younger folks to take an interest in their financial future, often for the first time. Of course, there's also the allure of cryptocurrencies, although count me, at least thus far, a skeptic. But all this generational change is driving a deeper kind of investor activism and recognition of the power that you and your clients and their money bring to the table. And this is like never before. Just glance through the headlines of the Financial Times on any day, and you see stories about meme stocks that have been talked up on remote Reddit boards. GameStop, AMC, they're widely considered down and out only 18 months ago. And today, you know the story of what's happened. Younger, broader groups of investors are piling on to our own websites. The largest share of traffic, in fact, on our UK site is coming from investors in the 24 to 35-year-old age group. Step back and think about that. Was that what you were expecting? I suppose different people picked up different pandemic hobbies, baking for some, gardening for others, investing for many. And that is good news for the work we can do jointly. But it also means that an advisor's job is getting tougher, and you have to think about it differently. The good news, I think, and this is really good news, is you have more opportunities than ever before to show how you can bring value to that relationship and build trust with the individuals that you're working with. So you've heard me say many times before that there's never been a better time for great advice. I still believe that. There really has never been a better time for great advice. But the culmination of what's happened during this highly unusual period reinforces the fact for me that it's also a great time to be an investor. So why especially now? I think it's particularly so because of the rise of sustainable considerations that is birthing what we at Morningstar are calling the new sustainability. The new sustainability. When we talk about the new sustainability, we are acknowledging that beyond acronyms, stereotypes, and preconceptions, sustainability is in fact the new face of long-term investing. Take that in for a minute. Sustainability is the new face of long-term investing. And for each of you, what this means is that as you're embracing sustainable investing as an integral part of long-term investing, it presents you with a fantastic opportunity to connect with clients and meaningfully grow your practices. After all, the mainstreaming of sustainable investing represents a chance for you to engage more investors much more personally and more deeply, and do it across generations of families that you're working with. Investing isn't just about investment process, but how you connect process to purpose. And therein lies a great opportunity for defining returns, risk, goals, all those things in a much more meaningful and personal way than ever before. So imagine if you have your sights on sustaining a growing business, not being able to address this part of how you're going to help a client manage their wealth in a meaningful way will hobble the growth of your practice. So the new sustainability is a recognition that ESG is no longer in the shadows. It's here to stay in the sunlight. Our research shows assets in sustainable funds are exploding, hitting the 2 trillion mark at the end of 2021's first quarter, with Europe still dominating, but the US beginning to come on strongly. In the professional advice industry, ESG is talked about alongside the need to know and understand your client's preferences. Now that's a start, but there's something much, much bigger happening than just tilting towards individual values. After all, it wasn't just about preferences when recently the activist hedge fund, Engine Number One, claimed 3 board seats earlier this month at Exxon, pushing the company away from climate-damaging fossil fuel and towards renewable energy. It was not about preferences for the pension funds or the large 3 asset management firms that you all know, BlackRock, Vanguard, and State Street, that voted in support of Engine Number One's proposal. This effort was about business risk and long-term value creation or destruction for big oil companies in a zero-carbon world. Just 10 years ago, Exxon was the largest company by market capitalization in the world. Today, it's far from even cracking the top 10, with its shares basically declining by a marginal amount over the past decade when we've had a rousing bull market. Chevron and Shell are also facing similar climate-related pressures in the past month, and there's only more to come. That's the thinking that's driving our Morningstar ESG indexes. These indexes are designed not only to support investors in transitioning to a sustainable global economy, but helping them identify the companies that will succeed as we transition to that type of an economy. Our Global Market Sustainability Leaders Index, for example, consists of 100 companies with the lowest ESG risk ratings as assigned by Sustainalytics, but also that the index is constructed to keep sector and regional weightings within 15 percentage points of our broad market indexes. If you'd like a flavor for the kinds of companies in that index, it includes companies such as France's Moet Hennessy Louis Vuitton, Lind PLC in basic materials in the UK, Taiwan's Fubon Financial Holdings, and Denmark's Coloplast in the healthcare area. This is where the world is going. Sustainability factors are generating robust, evolving sets of new data across the flow of capital, presenting investors with a huge opportunity to add alpha to their portfolios. This data has meaningful impact for investors and for companies that are adopting it, asset managers who are building strategies around it, and advisors who are bringing it all together for their clients. And it's even extending to areas of risk such as credit ratings, where our own DBRS Morningstar is now substantiating long-term ESG risk in credit analysis, and in private equity, where firms are now beginning to put ESG considerations into their due diligence process. Now, when it comes to investment professionals, I believe advisors have a responsibility, even a fiduciary duty, to educate investors about the risks and trade-offs inherent in these sustainability considerations, just as you do across all other long-term investment considerations, such as fees, risk, and performance. In the not-so-distant future, the idea of a sustainability-focused investment will become redundant. Pre-Brexit, the UK government committed to matching the ambitions of the EU Action Plan as a minimum standard, and we're all eagerly anticipating details of exactly how this will manifest. As new data and trade-offs enter retail markets, I believe understanding the nuances of these new sustainability factors will help investors make better investment decisions, enable financial intermediary to create products that are aligned to trends in public and private markets, and most importantly, help you grow your practices and show your value. And Morningstar, with our focus on putting ESG and sustainability at the center of our business, will be your partner in this journey. First, we're bringing transparency to the market by integrating ESG factors into our traditional research and ratings. Our equity research now incorporates sustainability considerations as fundamental to security analysis with easy-to-digest insights such as our economic moat rating and uncertainty ratings. And you might already know about Sustainalytics risk rating for companies, which I mentioned drives many of our own indexes. But did you know that these ratings are now displayed with 1 to 5 globe icons on Morningstar.com? Even as the world puts more attention on business risks that come with a warming planet, 2020 brought risks related to the S in the ESG to the forefront, and those risks may not be as obvious. Take, for example, Boohoo, the online clothing retailer. Now, you might have assumed that it has low ESG risk, but because of its supply chain practices, it has earned a Category 4 human rights supply chain controversy event. So Sustainalytics assesses the ESG risk exposure as low, but assesses its risk management as weak. Together, those two factors get the company a medium ESG risk rating of only 3 globes. You can dive deeper into this one and others by joining a panel this afternoon with my colleague, Casey Vosberg. You might already know, too, about the sustainability rating for funds, which is a roll-up of Sustainalytics ESG risk rating at the fund level and also marked through our 1 to 5 globe rating. I'm happy to announce that this October we will be expanding the coverage of the Morningstar sustainability rating by including ESG risk for sovereign holdings into the methodology. This adjustment will incorporate Sustainalytics country risk ratings and will add coverage for many thousands more funds, particularly those with fixed income allocation and alternative bents to them. With respect to asset managers and the funds they offer, we've rolled out our new ESG commitment level evaluations that help you discern whether it's just ESG marketing that you're running across or whether firms are truly committed to ESG as core to their investment process. European-based Stewart Investors and Rubico are among asset management firms earning our top level of leader. And an additional way we can help you manage through this complexity is through our Morningstar Managed Portfolios, which includes a series of ESG managed portfolios that we launched at this conference 2 years ago. This series of 5 multi-asset portfolios are aligned to our established risk profile and compatible with our other tools, but they have a meaningful and thoughtful ESG bent to them. And it's all supported by the high volume of trusted content that we produce for advisors who are speaking to clients. What I hope this shows you is that you can count on Morningstar to advocate alongside you and be your partner on this journey of transition. Together, we continue empowering investor success of more and more investors and creating more sustainable outcomes for the future. This is where the future is going, in fact, and we want to ensure that you have the tools to succeed in it. Now, on to the conference. We've got some stellar content for you in this year's lineup, featuring headline fund managers such as 2020 Morningstar Fund Manager of the Year winner in the UK, Claire Hart from JP Morgan, and bond investing legend Jim Levis from M&G. Plus, you've got the usual cast of fantastic characters from Morningstar, including our very own Hortense Boy. Come visit us at the Morningstar booth if you get a chance, where you'll find all the usual good stuff, but also information about the NSPCC, an organization dedicated to protecting children from abuse in the UK. Morningstar is making a donation for every attendee of this conference to help the NSPCC run its programs and protective and support services during this critical time, particularly because the pandemic has been so difficult to navigate. We hope you will join us in supporting the NSPCC. With that, let's get this conference kicked off. Enjoy.
Good morning, everyone. Welcome to Morningstar Investment Conference. My name is Evangelia Geka. I'm a senior analyst at the Manager Research team focusing on fixed income strategies. I'm delighted to introduce you to our first speaker this morning, Jim Levis from M&G. Jim is a very experienced investor and the Chief Investment Officer of Public Fixed Income at M&G and lead fund manager for M&G Global Macro Bond Fund, which has a Morningstar analyst rating of silver for its clean share class. Jim has prepared a short presentation about the importance of having a flexible approach in fixed income investing in the current market environment. Thank you very much, Jim, for joining us. The floor is yours. Thank you.
Good morning. Thank you very much for having me here today. Looking forward to this conference as much as you are. I was asked just before I came on by John, do I think that this is a defining moment for bond investors? And I think the answer is very possibly yes. I mean, every year in my 29 years of working in bond markets, we have started the year with a raft of forecasts from economists or from strategists, the newspapers, clients. Everybody has said this is the year that the bond bubble finally is going to burst. And every year, pretty much over the past 30 years, government bond yields have come down in yield year after year. We've made new lows in yields, bond prices have gone up, and we've seen inflationary trends be very much on a downtrend over this 3 decades period. But to John's question, is this the year? Is this a defining year? Things are very, very different this year. I've always been sceptical about the arguments that this is finally the year that the bond bubble bursts. This year, though, I think you can make some pretty clear arguments that things are different this time. Having said that, it's not as clear-cut as that. We know about a lot of these inflationary trends. We know that governments are going to be issuing lots and lots of government bonds, but there are still some very, very powerful factors that potentially could keep bond yields as low as they have been for a very long time. So today I'm going to talk about not just government bonds, but also look about valuations in credit that look pretty expensive at the moment, and also think about emerging market bonds, which is potentially the one area of global bond markets where you can still pick up some attractive yields. So let's start then with the very beginning of the argument that it's the end for bond markets. And the argument runs like this. We've had a year of lockdown. Everybody's saved up a lot of money in their bank accounts because they've not been able to go on holiday. They've not been able to eat out at restaurants. Savings are up. At the same time, we have 0 interest rates pretty much everywhere in the developed world. Very stimulatory. We have governments that are doing the most fiscal stimulus that you'll ever see, effectively. You know, you look at what's going on with Bidenomics in the United States, whether that's infrastructure spending, whether it's money going on furlough payments, unemployment benefits, just a huge, huge amount of fiscal stimulus. And also we have quantitative easing, of course, whether that's from the Bank of England or the ECB or the Federal Reserve. Big, big bond buying going on at the same time. And people are saying now, well, we've got the vaccination programme that's very, very effective in the UK. Europe is finally catching up. And in the US, they've got a surplus of vaccines effectively out there. Finally, we're going to get this unlocking. We're going to get unleashing of all these animal spirits that have been built up. Now, if you add on to that, and this chart here is effectively showing you the optimism that exists out there amongst corporates, so manufacturing industries, whether it's service sector or whether the people making stuff in factories, they've never been so optimistic as they are today about the prospects for their businesses. The same is true for consumers. Optimism is high. You look around the United States and you see that retail sales are strong. We see that house prices are incredibly strong. Car prices have gone through the roof. In fact, if you look at used car prices alone, they're up around 30% year to date. People have got savings, they want to spend them. There are, of course, some other factors around these used car prices. So, for instance, there's a big shortage of semiconductor chips. That means that companies like Ford are unable to ship as many new cars as they would have liked. Perhaps people are also nervous about using public transport, so they're buying used cars instead of getting a subway to work. But nevertheless, we're seeing in almost all areas of the economy great signs of an economic rebound. Now, the latest thing that people are worried about in the United States is about wage inflation. And actually, if you listen to Joe Biden, it's great. You know, we've finally got a radical left-wing president in the United States who's done it really stealthily. I'm not saying that's necessarily a great thing, but I'm saying what he's done is really quite interesting. He's the quiet US president who is unleashing higher minimum wages than someone like Barack Obama was able to achieve, a huge wave of fiscal stimulus and infrastructure spending, and he's done it without making a fuss, without tweeting or any of these things. Under the radar, we're getting a big redistributive and almost Keynesian response to this crisis that we're seeing in America. So higher minimum wages coming through, and Biden, when you hear him talking about the labour shortages, especially in the hospitality sector, will say, just pay your workers more money. And that's what he wants. You know, the lower paid worker in America has done really badly out of this 30-year bull market in inflation falling. Wages haven't gone up as much as earnings for the 1%. And as a result of this, Biden's going to be very open, as is the Federal Reserve, to seeing higher average earnings for the lower paid worker in America. And when you put all of these things together and say optimism is strong, we have higher commodity prices as we reopen, still some supply chain disruptions, and that comes down to that semiconductor problem that's hitting PlayStation 5. If you, like me, have been trying to buy one of those for your kids for the past few months, you just can't get hold of them. So those things exist as well, and it might be feeding through into wages too. And you put these things together and you say to yourself, well, I've been in bond markets for 29 years now, and I, for the first time, am saying, actually, this might be the big one. This might be the time that we finally break out from this low inflation world. So at the moment, I want to be slightly short duration in my portfolios, but I also at the same time realise that markets have got this wrong so many times over the past 3 decades that you really have to seriously believe that we're seeing a structural change in the global economy for us to get an inflation breakout and a response from the central banks that causes interest rates to rise dramatically and would therefore hit bond markets. I'm going to make the opposing argument, really. The thing that worries me about this recovery is still in the labour market. We've talked about these higher wages coming through, but why are we seeing higher wages in the US economy, given we still have a huge amount of unemployment? And the thing that I guess will be interesting, everybody listening in today who follows the economic data, is that whilst we've had some strong economic data in the US, the thing that's been really surprising over the past couple of months is just how weak what's called the non-farm payroll number has been. This is the big headline marquee US employment number. It comes out every month. It shows how many non-farming jobs have been created in the US economy every month. And we've had 2 months of really disappointing numbers. Despite all the good news elsewhere in the economy, we're not generating those jobs. And people are saying, why is this? Maybe it's for factors like, you know, if you look in the United States at the moment, we have really quite generous unemployment benefits over the course of the pandemic. So lots of the lowest paid workers in the US economy have been earning more by being unemployed than they were earning in work up to now. And that's a big disincentive for them to re-enter the workforce. So we're seeing lots of grumbling amongst hospitality industries in particular that they're simply unable to hire chefs or waiting staff or people to work in hotels. And the danger is really that those unemployment benefits have been very generous, have been the right thing to do. We've had that in the UK, of course, around furlough payments for people who have been laid off effectively and put on furlough by their employer. They've seen some fall in their salaries, but actually, on the whole, they've maintained their standards of living over the course of the pandemic. But we won't really find out in the UK until this month through to September, when those furlough payments start falling away and disappear entirely in September, or in the United States when those generous unemployment benefits fall away, starting now already. We won't really know what the true state of the US labour market is. And what these charts are showing you is really, you know, the extent of the fall in employment in the US has been absolutely dramatic. The extent of the rebound in employment has been pretty good too. But we still see this gap. We still see that in the United States there are 8 to 10 million people who are effectively either unemployed or underemployed. That's they've been furloughed, or they can't work as many hours as they would have wanted to find, or they're doing part-time work instead of full-time work. So this almost reserve army of the unemployed, as economists would call it, is still there waiting to come back into the labour force. They've been protected from having to find jobs thanks to generous benefits and furlough schemes, but we simply don't know what's going to happen later this year when we return to normal and people start looking for those jobs. How many people in the UK who are on furlough now are actually going to find out that they're unemployed? So I think the questions we have to ask ourselves are, I think it's very legitimate to expect that we're going to see some animal spirits unleashing, people wanting to go on holiday, wanting to eat out, to buy new clothes. But we won't find out until later this year what degree of scarring will actually be taking place in the economy. And scarring is really an impact that says if you have a really, really deep downturn, there will be people who have left the labour force that find it very, very difficult to re-enter the labour force. Lots of us who are around in the 80s will remember this from the kind of recessions we had in the UK. If you had lost your job in a steel mill in the northeast of the UK, even once the economy recovered, it's unlikely that you were going to re-enter the workforce. You were going to be in the long term and employed from then, and that was not going to change. I think things are a bit different this time round because most of the people who did lose their jobs were in the service sector, where those skills are a bit more transferable than the scarring we saw in the 80s recessions around manufacturing industries. So there's very much causes for optimism, but as I said, I think it's wrong to make this one-way bet that economies are going to recover and inflation is going to make a perpetual comeback. And that's why every central banker around the world is using the term that you're all going to be sick to the back teeth of by the end of the summer, and that's transitory. Transitory is what central bankers think is going on with inflation at the moment. And they're probably right on the whole, because when you think about inflation, it's mainly a year-on-year measure of where we were in 2020. Where were we in 2020? We're in the depths of the coronavirus depression. We had oil prices that had gone negative, a global trade that had stopped, eat out to help out, things like that, cutting the prices of everything. So simply because of those base effects from where we were a year ago to where we are now means that we were always bound to have these super high year-on-year inflation numbers. The question is for Andrew Bailey at the Bank of England or Jay Powell at the Fed, how long does this last? We've perhaps already seen the peak US inflation number at 5%. And for the rest of the year, I can accept that we're going to have some elevated inflation, but is it going to be anywhere near 5%? I think we're probably on a downtrend now. And what happens with wages is really going to be the most important thing for all of us going forwards. So let's have a think about bond markets, what's been going on this year. I've always said that bond markets are the most interesting area of financial markets, way more interesting than equities or commodities or anything else. It really is the encapsulation of all economics, all geopolitics, And what goes on in bond markets, of course, determines what happens to your equity funds or your property valuations. The risk-free rate, this rate of the 10-year US Treasury bond yield and longer-dated US Treasuries, determines all other asset valuations. So when you see this chart and you see that a year ago we had yields down below 0.5% in the United States, they went up in March this year to 1.75%. That obviously caused a great deal of concern for global markets. For me, having been short duration over this last 3-month period, I actually think it's time to buy back some duration at this point in time, to start buying some government bonds again, because this is quite a significant move. It's a move that could start slowing down the global economy for the reasons I talked about. 10-year government bond yields, 30-year government bond yields are the rates at which corporates might borrow in the global markets. So when those yields go up, rates for corporate borrowing go up as well, starts to slow things down. Rates for mortgage investors in the US, if you're taking out a mortgage, that's based on the 30-year US Treasury bond yield. So if we move much higher than this, up towards 2.5%, 3%, as some commentators have forecast, that really does start to slow the global economy. And from my point of view, as a value investor in fixed income, I want to ask the question, what over my 30-year career as a bond investor has really changed over the course of coronavirus? I think there have been some structural changes as a result of what went on there. But the big mega trends that have led to government bond yields falling year after year after year remain in place. And actually about 3 weeks ago, a bond that was issued when I was at the Bank of England back in the 1990s with an 8% coupon, an 8% gilt, matured. Just shows you how far we've come since the 1990s in terms of bond yields, where long-dated gilt yields were at 8, and today long-dated gilt yields are about 1.5%. So what are the mega trends that have driven these bond yields down? Are they likely to change in the decades to come? Well, I think you can summarise them as, first of all, demographics. The developed markets are ageing, elderly economies where their investors are reaching or in retirement, and that means that they want safe assets. They want bonds that aren't volatile. They don't want risky assets. They want safe assets that provide income. So over this period, we've seen ageing populations in the Western world, much like Japan, and perhaps that's where we're heading, Japanification. Old populations that want security and income, and that means they want bonds. The second big mega trend is around technology. Let's think, this is an internet era where we can all go out there and find the cheapest thing in the world via Amazon, via eBay. And that's the same thing for corporates as well. They can go and find the cheapest things wherever they may be. Technology's also driven productivity gains, and it's also driven down wages, and that's perhaps the dark side of technology's rise. If you go into the office in an Uber in London, then you know about the gig economy, people who only work when their app tells them there's work available, and that's driven down wages globally as well. And the final megatrend is really around globalization. We're in a world where free trade exists pretty much everywhere. Some dangers around that, around Brexit perhaps, and trade barriers and trade wars with China. But on the whole, globalization and free trade has led to lower prices. And it's also meant that there's always been the threat that if you're BMW in Munich, you keep your wages down by telling your workers that you're going to move to a Romanian factory or even a Vietnamese factory if they don't have restraint when it comes to wages. These megatrends are still in place. And we've also had a world, this is my own personal valuation metric for US Treasury bonds. It's really looking at the Federal Reserve's published, every time they have a meeting, they publish where they think long-term interest rates are going to be in the United States. The average of that is the red line on the chart, the median line there. Whenever we get outside the band I've put there in terms of long-term US Treasury bond yields, then I think there's some value. And we got in March and April this year, when we saw that big sell-off in US Treasuries, to a world where it's normally been a good buying opportunity on a pure valuation basis. And so we added some duration back into the fund there too. So I'm not going to argue heavily with those people who say that perhaps this time is different, that all the stimulus, the fiscal stimulus, the monetary stimulus, the unleashing wave isn't going to have an impact. I think it will. I think we will have some higher inflation. And of course, the other thing to bear in mind is that central banks want there to be higher inflation. If you look at the Federal Reserve, they changed their inflation target from 2% to something they're calling flexible average inflation targeting. So if we had a period like last year where inflation was spectacularly low, or during the global financial crisis where we had periods of deflation, then you're going to allow inflation to be higher for a long period in order to catch up. And so that's an important thing to bear in mind. Maybe central banks don't care as much about inflation as they used to. But for me, on a valuation basis and on the fact that those big mega trends for bonds remain in place, I think it's time to be adding a little bit of duration back into portfolios. Emerging markets I quickly want to touch on. Maybe in the Q&A, if you've got questions about this, we'll have more time for it. But when I look around global bond markets, I don't see tons of value anywhere apart from potentially in emerging markets. And of course, these are going to be very volatile areas. There's going to be geopolitical risks. We see this around Russia with sanctions, for instance. We see issues in Mexico and Brazil at the moment. We've seen some defaults in Latin America. So whenever you invest in emerging markets, you're ready for these idiosyncratic issues that could cause you to suffer some losses in these individual markets. But if you're diversified across the whole of the emerging market bond and equity world, you can see that the valuations are completely much more attractive than they are in developed markets, for good reason. You know, emerging market demographics are different. We have young, dynamic workforces that don't have these huge pension liabilities. We don't have the healthcare costs that we have in the West. So government debt to GDP ratios in emerging markets are generally lower than we have in Japan or Italy, in the UK, the US, where debt to GDP ratios are 100% to over 200% in some cases. So fundamentally, emerging markets have been converging. They have lower inflation than they did in the bad old days in the 80s and 90s. Greater rule of law, all of those good things. But if you have a look at the chart, you can see that the real yields available in emerging markets are very much positive. So these are inflation-adjusted yields. You can get 3 or 4% real yields there compared to very negative real yields, inflation-adjusted yields in the Eurozone or the UK. So if you're looking to diversify your portfolio, emerging markets looks to be the one real area of valuation, in contrast really with credit. And I don't see anything going spectacularly wrong with corporate bond markets over the course of the next year or so. Corporates, when they saw COVID coming, did exactly the right things, and central banks did exactly the right things. The central banks stepped in even before I'd gone home from my office in Leadenhall Market. You know, whilst we're still in the office, before lockdown came along, the Bank of England had decided it was going to reopen its corporate bond purchase programme, preventing a liquidity event from taking place there. The Fed did something similar, the ECB did something similar, and corporates did the right thing. They borrowed as much money as they could for as long a duration as possible. So lots of them locked in corporate bond yields at low levels for 5, 10 or even 30 years. So the risks of defaults coming through in a big way in 2021 are almost zero. Even 22, 23, the default outlook is pretty moderate for corporates, even though some of their fundamentals are starting to deteriorate in terms of the amount of debt that they've taken on. But you can see from this chart that you're just not getting paid to invest in corporate bonds to anything like the extent you were in March, April, May in the course of 2020. You know, you were getting 300 basis points of additional yield for investing in credit back then, in good quality investment grade. Today, we're not quite at record low credit spreads, but getting down towards the sort of levels that we were going into the global financial crisis. And for me, that means I still want to own some investment grade bonds in my portfolio, but as credit has rallied, I've aggressively been cutting the amount of credit in the portfolio, not because I'm worried about defaults, but simply you're not getting paid enough to take those risks. This is my final slide of today, thinking about currency, because we've had quite a strong run for the UK pound over the past year, partly because people have looked at our vaccine response, the fact that we have most of the adult population now fully jabbed. The UK economy will be reopening pretty almost definitively in about 2 weeks' time now. And so people have been quite optimistic about the prospects for the UK economy. And I agree with that. It's been a good place to be in terms of the economic outlook over the past few months. But the pound has got expensive. And some people think that you can't value currencies, that currencies are simply almost the share price of a nation. I'd really disagree with that. There are good ways of valuing currencies. This is the currency snail. It looks like a snail shell. Deutsche Bank produces this chart every month, and really it's 3 different ways of looking at currencies and valuing them on a fundamental basis. You all know about the Big Mac index, I think, that the Economist publishes at the back of the Economist every month, really comparing the prices of goods in different countries around the world and saying, well, what's that telling us about valuations? Because the ingredients of a Big Mac, beef, bread, lettuce, sauce, energy, labour, they're exactly the same wherever you go in the world. And therefore, if the prices are different, that's probably telling you something about currency valuations. You can think about other ways of looking at relative valuations as well, around different interest rates in different economies or different inflation rates in different economies. And then if you put these all on a chart, like a clock face with the most expensive currency in the world at around 11 o'clock on a clock face and the cheapest at midnight, as you go around from Brazil, the world's cheapest currency, you hit Japan, Colombia, Turkey, you can see currencies getting more and more expensive, and the pound sterling is something like 9 o'clock. It's pretty much in the top quartile of the world's most expensive currencies. The most expensive currency, Switzerland, well done Switzerland last night, by the way. US dollar's also up there somewhat as an expensive currency now. So we use this within the fund to help identify the cheap currencies, and they're the ones that we want to be overweight on in the portfolio, and then the more expensive currencies on the other side. And you can see now that sterling has become, having been a cheap currency a year ago, has become an expensive currency. And for me, that's telling me that I want to be diversifying my portfolios away from the pound and into some of these cheaper currencies elsewhere. That's all I'm going to talk about today. Now we've got time for a few questions, hopefully. You can send those in on the website, and I'm going to sit down and answer some questions. Thank you very much.
Thank you very much, Jim, for this very interesting presentation. We actually have quite a lot of questions coming through, but actually we won't have a lot of time to go through all of them. So one of the questions, the topic for this year is inflation. There's currently a debate going on between market experts on whether recent inflation numbers will prove to be temporary or sticky for many years. What's your view on medium to long term in terms of inflation?
Yeah, I really think that there is a chance, but it will all depend on those labour numbers. It will all depend on whether employers start hiking wages. If we think back to periods of time that we have had very high levels of inflation, it's really been around times when trade unions have been strong. So think back to the 1970s. That's not the case now. People, as we talked about, the Uberization of the gig economy workers, they don't have pricing power. Workers have not had the upper hand. And that's why Joe Biden has just said, pay your workers more. You know, if that happens, if workers do start all earning $20 a barrel, $20 an hour, rather than, at the moment, some of them are on sub $10 an hour, then they'll have more money to spend, they'll go out into the economy, and there is a chance that we do start seeing higher levels. But as I say, these big secular factors have been driving inflation lower and lower for a long time. And I think the ageing population thing is really important. You know, we look at Japan, and old populations vote for economic policies that keep inflation low, because if you're a pensioner, you are probably on a fixed income or a low income, you can't cope with the price of your groceries going up year after year. And so as we end up with Europe ageing, the United States ageing, these older populations are going to vote for policies that probably won't be as inflationary as Joe Biden's hope when it comes to wages. So watch the wage numbers like a hawk. That's what I'll be doing, and bond market participants will be doing from here on in.
Great, thank you very much for that. And possibly we have a few minutes just for one more question. Another topic apart from inflation is ESG. So we hear a lot about ESG and corporate bonds. From your side, I want to hear, what about sovereign bonds?
Yeah, I think this is the area of the market that is really underserved at the moment. So at M&G, we do it ourselves. We have our own sovereign ESG framework, because you can't buy it in from anywhere in any robust way at the moment. And I think it's as important. You know, it's all very well boycotting a US defence manufacturer, Lockheed Martin or something, because they're involved in defence technologies, whereas your portfolio might be full of US Treasury bonds that are effectively buying the stuff from Lockheed Martin. And then we have, of course, the issues around China. China has joined the global bond indices now. It's, in fact, a bigger weighting in the global bond indices than the gilt market in the UK. And yet, what do we think about human rights in China and democracy? How important are these factors? So I think this is going to be the debate for the next 5 years, in a way that nowadays everyone thinks about. When you go and see your corporate CEO, you ask them about how they're treating their staff and, you know, are they involved in pollution and so forth. Yet when the US left the Paris Accord under Donald Trump, should that have been a signal that everyone should have sold their US Treasury bonds? So for me, it's really difficult how, you know, the US Treasury bond market's the biggest bond market in the world. I've got really, you know, Joe Biden, if I phoned him up, is not going to take my call for me to shout at him about global warming in the way that I probably could do that with a corporate CEO and say, look, we're a big investor, it makes a difference. I'm not big enough, and no single bond investor is big enough to change Joe Biden's mind about climate. Thankfully, he's going to rejoin all those things that Donald Trump left. But it's really important for us to consider these things and to engage with governments as much as we're able to. And it's a bit easier in emerging markets where their access to capital markets is more difficult for them. So on that basis, we can make a difference.
Great, thank you very much. And since you mentioned lastly about the emerging markets, where do you see opportunities in emerging market overall at the moment? More on the local currency, hard currency, where are the biggest opportunities?
Yeah, I mean, you saw the chart on currency valuations. It looks like, you know, there's a real mix. You have some very, very cheap currencies down at the bottom, Brazil, Turkey, and at the other end of the spectrum, you know, there are some currencies that have done spectacularly well in emerging markets. But as a whole, I think local currency bonds are where you get those higher inflation-adjusted yields. So, you know, you could lend to Latin America through dollar-based bonds, but probably the real valuation opportunity, if you're thinking across all bond markets, the real valuation opportunity is going to be in local currency bonds. You want to be incredibly well diversified. I still worry a little bit about the third wave of COVID. You know, if you look at Africa at the moment, they have 1% of African adults vaccinated compared to, you know, what we know about in the UK and Europe. So there is a danger that we've got a bit blasé about Africa having a young population not being impacted very much by COVID. Is that going to be true of this new, more virulent Delta variant? Might they have a big issue there? So got to be careful, got to be diversified, but on a valuation basis, local currency emerging markets is starting to look really attractive.
Thank you very much. Thank you very much for this presentation and for answering all these questions. We'll follow up with some of the questions. Enjoy the rest of the conference. Thank you very much. Thank you.
Good morning, everyone. I'm Anastasia Giorgio and Head Up Advisory Solutions for Morningstar. I'm excited to introduce the next session, which will be run by my colleague Keith Speck. Keith once turned down the opportunity to play rugby for Bahrain and is now the portfolio specialist for the Morningstar investment management team. As you all know, the world of ESG is rapidly evolving space driven by both client demand and regulation, and an array of new definitions like Article 8 and 9 on funds. In this session, Keith and his panel of experts will talk about the latest ESG trends and give some practical advice on how to integrate ESG into the advisor practice. Now over to Keith.
Hello and welcome to Morningstar's session, The Practicalities of Implementing ESG into the Advisor Practice. I'm Keith Speck, Portfolio Specialist at Morningstar Investment Management Europe, and I'm delighted to be joined by Katie Vosberg, Associate Director of ESG Research at Sustainalytics, and Andy Mayer, Financial Advisor and owner of Mayer Brownsword Independent Financial Advisors. Andy brings with him a wealth of experience, having been a financial advisor for 27 years. During today's session, Casey will set the scene on ESG, outline Sustainalytics' approach to ESG, and look at the changing face of ESG and regulation. I'll discuss ways of introducing ESG into conversations with clients and the benefits of these conversations, as well as the importance of separating values from financial risks. Andy and I will discuss what he's hearing from his clients and how he approached introducing ESG investing into his business. We'll then address any questions you have arising from today's presentation, so please do feel free to send in questions as we go along, and we'll look to address as many of these as we have time for at the end. Casey, welcome, and thanks for joining us today. It's great to have someone from a market leader in the ESG space to discuss such a highly topical subject. So, Casey, turning over to you, we see a lot of news about ESG constantly in the press. What's dominating the headlines for you?
Yeah, so it has been said that 2020 was the year that ESG went mainstream. And it is true that for a lot of people, COVID-19 and some of the other events of the past year have brought to light some of the systemic risks from material ESG issues. So anything from the supply chain for active pharmaceutical ingredients to the occupational health and safety concerns at essential businesses, or by threatening progress on gender diversity in the workplace, COVID-19 has really revealed how interconnected we all are and how vulnerable our markets are to shocks. We've also witnessed a number of social movements, concerns about racial equity in the United States, which many companies responded to by looking critically at diversity, equity, and inclusion, not only performance, but programs in their workforces to make sure they're able to continue to attract top talent. Of course, for many companies, talent is their most valuable asset, but also to tap into the diversity premiums that have now been well documented in literature. And I'm sure you're all familiar with the case of Boohoo, the online retailer accused of modern slavery right in the UK, so very close to home for many of you. I think it's quite telling that Boohoo's share price took just as large a hit in the aftermath of its modern slavery controversy, when a few of its clients temporarily removed its products from their platforms, than it did in the pandemic market sell-off in March and April of 2020. So at the end of the day, these are really more than just headlines. What we're seeing here is really a paradigm shift driven by a realization that failing to consider material ESG issues can result in meaningful financial consequences at the company and portfolio level. So what you see on the side is really just a sample of E, S, and G events that have not only spurred interest from investors and companies, but also underscore the sustainability concerns shared by the vast majority of people around the world. And I think the massive flows of money into ESG funds and some of the regulatory developments that we'll talk about later are evidence of this.
Thanks, Casey. Clearly, there's a lot of information and news flow to take into consideration. How does Sustainalytics think about ESG risk when analysing a company?
So our ratings are focused on material ESG risk, and in particular downside risk. Our flagship product, which is the ESG risk rating, it measures unmanaged risk from the ESG issues that we've identified to be material for each company. And so in total, we track a total of 20 material ESG issues. And these include things like resource use, carbon, both in own operations and products and services, bribery and corruption, just to give a few examples. And to arrive at each company's rating, we add up the unmanaged risk from the ESG issues that we've identified to be material for that company in order to get to an absolute measure of ESG risk. So you're probably wondering, how does this actually work in practice? So our rating has two dimensions. There's exposure and management. And we consider each company's business model. So what are the products and services the company offers? What are the location of assets and revenues? What is the regulatory environment? Does the company have a track record of controversies? And we consider all of these factors in order to estimate the magnitude and likelihood of financial impacts from each ESG issue. And then we look at the company's management, which is, of course, an important part of every ESG rating. And here, we're really looking at how prepared is the company to face these risks. So we pull from over 200 indicators that assess the strength of policies and programs that are relevant for each material ESG issue. And our focus on materiality means that we only assess the issues that are most relevant for each company. So we recognize that Pfizer is exposed to a different set of ESG risks than Microsoft or BHP. For a mining company like BHP, emissions, effluents, and waste, and occupational health and safety are highly material. But for Microsoft, we don't consider those issues to be material at all, but rather data privacy and security and human capital. In addition to material ESG issues, you can see here that the foundation of our rating is corporate governance. And so that means that we assess all companies on their corporate governance practices. And this includes things like board independence, shareholder rights, and remuneration. And this reflects our belief that strong governance structures are essential to manage all types of ESG risk. And then finally, one unique aspect of our rating is the concept of idiosyncratic ESG issues. And these are issues that aren't typically material for a company, but they do become highly material when a company is involved in a significant controversy. And so again, one example is Boohoo, the online retailer that is not typically exposed to supply chain human rights issues given its business model. But nevertheless, it was involved in a significant controversy related to allegations of modern slavery in the UK, which is quite exceptional. Another example of an idiosyncratic ESG issue is Bayer, so a pharmaceutical company that acquired a significant idiosyncratic risk related to the health and environmental hazards associated with pesticides. Again, this is an issue that isn't typically material for a pharmaceutical company, but it acquired this issue when it acquired Monsanto. So the result, what we offer to our clients is a mix of quantitative and qualitative analysis for each company. So the ESG risk rating score is complemented by an analyst view. And this is where our analysts have the opportunity to provide additional qualitative insights on the overall ESG risk profile and exposure and management for 3 of the most notable material ESG issues for each company.
Great, thanks, Casey. So we're looking at how companies are minimizing financial risk from ESG issues when coming up with an overall rating for a company and the ability to compare across sectors. So what are the key trends that you're seeing in the ESG space now, and what's been the impact on the regulatory environment?
Of course. So first and foremost, we've seen a huge influx in sustainable funds. So sustainable funds now total nearly $2 trillion US, and Europe is really at the forefront of this trend, accounting for nearly 80% of sustainable funds. And there are a few things that are driving this, and they're really all connected. So first of all, there's the regulatory push, which I'll talk a bit more on the next slide. There's also been a lot of improvements in corporate disclosure, and this is in part driven by, some of the new regulations. One example in the UK market is the requirement for companies with more than 500 employees to disclose gender pay data. There's also demand from consumers, including investors and other stakeholders, so employees, civil society, not only for better disclosure, but also for investment options that are aligned with their values and that minimize downside risk from ESG issues. And finally, in response to this demand, you also see a lot of product development of sustainable investing options, which again is a driver for some of the regulatory interventions like the EU Sustainable Finance Action Plan. So if you go to slide 6, you can see that sustainable finance policy is really a 21st century phenomenon. So this graph here shows that the pace of new policy interventions related to sustainable finance picked up significantly around the year 2000, with another big jump around the time that the UN Sustainable Development Goals were launched in 2015, and the Paris Agreement, which was signed in 2016. This is a trend that will only continue, and we do expect that there will be ripple effects in all markets by raising the bar for sustainable investing around the world and also directing capital to more sustainable economic activities. So although corporate disclosure of ESG information is already trending upward, and this is something that we've observed at Sustainalytics. So we now have over 1,500 companies that respond to our feedback requests each year. We do believe that investors will only benefit from a more complete and comparable baseline of material information. And that is something that new regulations, such as mandatory disclosures, can bring about.
Thanks, Casey. Certainly, we're in an environment that's undergoing a lot of change at the moment. Recent research has dispelled the idea that ESG-focused investing is only of interest to younger generations. This interest is actually really consistent across all age groups, and a study that Morningstar Inc. Carried out actually supports this, with 72% of respondents of various ages and genders expressing interest in sustainable investing. So given this level of interest in sustainable investing, having a strategy to address this can really help advisors grow their business by differentiating it from others. Asking clients how they feel about sustainable investing is actually one of the most powerful questions we can ask of our clients. By understanding what the client really values and the causes they feel passionate about, you get a much deeper understanding of them as a person, and that helps you deepen the relationship that you have with them, as it results in conversations that are more personal than just asking about assets and liabilities or income and expenditure. Now, for some people, asking this question can prove difficult. So how can we go about this? And I certainly don't want to preach to an audience who are far better placed to ask questions of their clients, but I'd just like to offer up some observations here. And really a good place to start is defining what sustainable investing is. Now, we define sustainable investing as a long-term approach that incorporates environmental, social and governance, the ESG factors, into the investment process. Some of the factors that ESG investors consider important include things such as climate change and carbon emissions, energy efficiency, human rights, labour standards, corporate ethics and board diversity, amongst many others. So it's important to discuss ESG factors with clients clearly and succinctly so that they really understand what sustainable investing means. In spite of its rise in popularity and demand, ESG investing and related investment products can be a mystery to many clients. The oldest and most limited type of ESG investing focus on exclusionary screening, which simply avoids investing in industries with negative ESG characteristics. A broader and more modern type of ESG investing is based on sustainability, and these products feature a strong tilt towards the best scoring ESG companies and often involve direct engagement to promote better sustainability outcomes as part of the investment objectives. The consideration and assessment of company ESG practices is rapidly becoming more important for long-term investments. Therefore, all investors should understand why ESG matters. One of the myths surrounding ESG investing is that investors must accept lower returns to conventional investments, and that simply isn't the case. And investors should expect different returns at different times. Sometimes these returns will be greater than those of a conventional investment, and sometimes they will be lower. Now, there's a growing awareness of the potential financial impact of environmental, social and governance issues, as Casey's discussed, and in recent years there have been numerous events with wide-reaching implications for company leadership, sales and stock prices. Current business models must be responsive, and investors need to have the information to identify successful leaders whose companies aim to mitigate risk by having good sustainability practices. We've also heard from Casey how ESG regulations are accelerating, underpinned by a movement to make these disclosures a standard part of corporate communications. EU and UK regulations are requiring asset managers, advisors and pension funds to consider ESG risk as part of their fiduciary duties. EU regulators also require credit rating agencies to disclose how ESG factors are considered. And all of this really reflects a broader trend towards integrating ESG into your financial decisions. Now, these ESG risk factors are a part of the overall risk profile of an investment. So if we think about ESG risk in this context, sometimes it will be overly discounted in the price of an investment, and sometimes it will be under discounted, the same as for any other risk factor. But when we look at values-driven preferences, then the situation changes, as when you start to exclude businesses based on their activities, then you're both narrowing and reshaping the universe of investments. Again, this can lead to divergent returns, and sometimes this will be positive, sometimes negative. A key factor is to have that values discussion with your clients and to ensure they understand the potential impact on future returns. We're now going to hear from somebody on the front line who's talking to clients about ESG. Andy, welcome. We've heard from KC about the marked pickup in fund flows, particularly in Europe. What are you hearing from your clients, Andy, and has there been a pickup in inquiries for ESG products?
I think since the last couple of years we've seen a massive increase in the number of people who just say to you, do you offer this? I think when you look at the principles for responsible investing, 68 trillion is being managed that way. I think you look at the Paris Accord, clients are now asking you, do you offer those sorts of services? Do you have that? And there's been a huge increase, especially since COVID, but even before that we were seeing a lot of clients asking you on the inquiry forms, did you offer that sort of service to them?
Great. And your perspective on ESG, how do you go about talking ESG to your clients? Not the easiest conversation to have sometimes.
I think what we did, we changed some of our forms a few years ago to incorporate ESG in it, but COVID gave us a great opportunity. Everyone was stuck at home, so instead of doing face-to-face meetings, we were talking to them through Zoom or Teams, and we were actually being able to say to them, how's this working for you? We're not using petrol, we're cutting down the carbon footprint, we're not going to send you paper, we're actually going to send this electronically. So it gave you an open door really with the clients to do this, and it's worked out, I think, for probably the financial services industry remarkably well. Clients have been very adaptable to it, but it was also, I think, more than that. Over the last number of years, clients have wanted to hear more from advisors. And my fear was that if we didn't talk to them about ESG, somebody else might be. And who wants to turn up to work on a Monday morning with a letter of authority saying, we've gone to another advisor, and you ring them and say, well, we do that. And they went, well, you didn't tell me. So I think if we don't tell them, we don't have the conversations, Keith, we're really in danger of missing out on business that we've already got, and it's going to go somewhere else.
Yeah, that makes sense. You've got to be able to give these services to your clients. And you talk about papering and adding questions. So how else did you prepare your business for ESG investing?
I'd like to sit here and tell you it was a light bulb moment. It hasn't been. It's been a gradual process. So the new clients we'd be taking on, there would be a section there. But existing clients, we introduced that into the progress meeting, the ongoing meeting, talking to them about their existing portfolio, but then saying, are you interested in looking at ESGs? We've done podcasts, and actually next month, Dan Kemp is our guest speaker on ESGs. We've done monthly podcasts since the COVID crisis started. We've done, previous to COVID, we did seminars. Now we've done webinars on them. And we've sent out newsletters. But I think what we've tried to do is when we're having a conversation with clients, is talk to them. Ask just general questions. Where do you buy your coffee from? Well, I don't go to a big chain because they don't pay corporation tax. Where do you go? And they might say they support the local retailer. And those conversations have been allowed us to get more in depth and talk to people about what they feel. And I think, bearing in mind our industry keeps seeming to have the odd crisis like Woodford, we've been able to talk to people about governance. We've been able to say, are you concerned about how people are paid? Are you concerned about how your money is run? And the reverse is that I think years ago people looked at the performance and went, I'm not certain. People are very worried that they might be invested in the Woodford Fund or BP when there was an oil crisis, and suddenly they've seen their investments go wrong because the governance wasn't there. So the last few years have really, really opened it up for us as advisors to have those conversations with people.
Yeah, and having that conversation, I think as we were saying earlier, really helps you get to know your clients much better as a person, and you form a much deeper bond with them, I think. And you chose to outsource management of ESG products rather than take it in-house. What was the rationale, thought process behind that?
There was various reasons. We could be here for 3 or 4 days. But one of the best examples I can give you is a few weeks ago we picked up a client, really lovely girl, wanted to go with ESG. We'd had numerous conversations. Just at the point of signing, email come in, can you tell me the percentage that's invested in fossil fuels? Well, if that had been me left on my own, there's the week gone. So we get hold of Tom. Tom gets hold of the fund manager, comes back within 24 hours. My job's done. 2 emails, I've done. There's also the regulatory issues. What happens if I put someone in a fund that doesn't match criteria and I get a complaint? I don't want that. There's also the fact that people want an expert. This is sort of a new area, and a lot of people are concerned. So if you can say, and as you know, I back into Morningstars, we use Sustain Analytics and your managed portfolios. I give them the research that you guys do and say, this is who we're using. It's not me just sticking a pin in something. We're actually using the best of the best. That gives them the reassurance that not only is their funds professionally managed, that they were minimising risks. And that for them gives them the confidence that they might not be swapping, as you spoke earlier, performance for their ethics. They're actually going to get performance alongside their ethics. And I think people are really, really happy with that. And the other thing we found with when we're sort of outsourcing, would people really be happy with small companies having the resources to manage this for them? And I think it gives them the security that their money, their children's money, their legacy that they want to leave is invested in the right way, but it's being managed by people who know what they're doing. Because let's face this is an incredibly complex area that if you look at the cost, we've either got to pass it on to the client or we've got to take it on board. And by using a professional managed service, we can get the cost down. You guys can also blend active and ETFs, which the clients, because one of the big issues with it was the initial costs. Now that has dropped by blending ETFs with active. You can actually sit in front of a client and say, you're getting what you want, but you're not paying a heavily sum for it. It's actually alongside other portfolios. That has been a dream ticket for us. We can go with confidence, speak to a client, and they always go, it's going to cost me more, isn't it? You go, no. And that has made a massive difference to us.
Yeah, it's a huge benefit in an environment that is fee pressured, and I guess outsourcing frees you to get to know the client through those in-depth conversations about their values.
I think, Keith, what COVID taught us, we need to be in communication with our clients. So if I'm spending all the time sitting in an office researching it, I'm not talking to my clients. When we're talking to the clients, we've got business opportunities, we get to know them. If I'm sitting in my office on screen for days and days and days, I'm not speaking to the people who ultimately I need to speak to. By outsourcing it, it's a massive time resource for us, which we couldn't manage. I think if you're a big multinational with thousands of employees, maybe you can do it yourself. But for most IFAs, there is no chance that they can do this successfully, especially this complex area, without outsourcing it. And it's allowed us to offer these portfolios and be profitable.
Yeah. And so talking about ESG with your clients, you know, it's beneficial for you, clearly beneficial for your business, for your clients. And, you know, what are the other areas where you really think that's helped you get ahead and being prepared for this?
I think one of the hardest things is to take on clients. So when you get a client, the last thing you want to do is, like I said, is lose them. So if £1 in 3 of new money is going into ESGs and we're not talking about it, somebody else will be to them. And if your clients are going down to the golf club or having lunch and someone says, oh, my portfolio's done really well, I'm in this, and you've not mentioned it, all that hard work attracting a client can go. And I think it's EY Wealth have done a survey recently that said that 75% of clients are interested in sustainability. But over 75% were also interested in having ESG in their portfolios. Now, EY Wealth's average client, I don't think it's 25, because there's this misconception in our industry, oh, it's only for the young. If you're not talking to them, these people are going to hear about it from somebody else, and they're going to go somewhere else. So part of it is to help them. I'm brutally honest, part of it is to protect our business, because if we're not doing it, somebody else might offer them that solution that they didn't think you did. And the amount of times you speak to advisors and they say, oh, a client's gone and done it with somebody else. And you go, why? They didn't know I did it. So we're telling them as often as we can, we offer this solution, because we found people who've been with us 8, 9 years have suddenly gone, now I want to move it. Can we have an ESG portfolio? If we hadn't have done it, somebody else might have taken that client, and we've lost a client we've worked really hard for. So it's a lot of it is self-preservation, but it's also the way the world is going. I think all funds within a number of years are going to have this as a mandate. So if you're not doing it now, you really are going to be left behind.
No, that makes perfect sense, Andy. Thanks, Andy. It's fascinating to hear the views from somebody who's at the sharp end and talking to clients. So we've covered off the learning objectives that we set at the outset. Also like to thank Casey for her enlightening views, and really thanks to all of you for joining us today. And now really happy to open up for any of the questions that have come in during today's presentation.
Thank you for that, everyone. We're joined here today with Keith, Andy, and we've got Casey on the Zoom link, and we've got time for some Q&A. So I'm going to start with a question for Andy. Andy, how do you manage the trade-off between an investor's goals, their risk tolerance, and their ESG preferences?
I don't think it's a trade-off anymore. I think you can actually combine all of them. I think if you've done the proper questioning at the start, I think there was, Keith mentioned it earlier, there was this idea that ESG portfolios were worse, or you were sacrificing either performance or there was increased costs. Well, I think those days have gone. So I don't think you're sacrificing anything for the client at all. In fact, I think in a lot of cases, you're giving them exactly what they wanted. But I think at times in the past, we've probably not spent enough time talking to our clients about what they did want. And with this new area opening up over the last few years, it's given us a chance to talk to them more. So I don't think it is a trade-off. I think you can combine all three.
Okay, thank you. We've got a question for Casey as well. Casey, how are the new regulations, like the EU taxonomy, changing the way ESG ratings are compiled?
Yeah, I would say primarily by just simply raising the bar for the type of information and the depth of non-financial information that companies are required to disclose. So here at Sustainalytics, we've already witnessed corporate sustainability disclosures trending upwards for several years now, slowly but surely. And this, along with evolving best practices, means that we're able to update our ratings and make sure that they capture the most relevant information. So whether that's through introducing new indicators or metrics or qualitative aspects of our rating. So in general, it's a positive. And if you take the example of the EU taxonomy and the non-financial reporting directive, we can certainly expect more detailed disclosure on sustainable business activities or ESG risks, which again just allows us to incorporate into our own ratings and provide a more robust assessment about the ESG risks that a company faces.
Casey, I'll stay with you. Another question is, what type of data sources do you use for the ESG ratings?
Yeah, sure. So we use a mix of data sources. So primarily company reporting is obviously a big important source for us. So annual report, sustainability report, proxies, but we supplement this with third-party data. So whether it's internal or external, qualitative, quantitative. And for our controversy research, we also pull from over 60,000 media sources that we monitor on a daily basis. So that would include, so again, just broad spectrum of media sources, but also regulator and NGO sources. And then again, we supplement all of this with some industry or topic specific third-party sources. So just to give you a few examples, that could be things like FDA data on recalls or certain NGOs. We look at ChemSec here in the EU for data on hazardous chemicals, or ICER in the US for analysis on the cost effectiveness of pharmaceuticals.
Okay, thanks, Casey. Another question for Andy. Andy, what are the top 3 actions you would recommend to an advisor that's just starting out incorporating ESG into the practice?
I think the one I've just mentioned and gone on about a lot in the speech is outsource the research. There is no way we could have done it successfully without outsourcing the research, because the time, the due diligence and the compliance risk. I think secondly, you've got to be authentic. You've really got to believe in what you do. So when we do our Zoom meetings or our WebEx meetings, we have a copy of my daughter's ESG portfolio. We have a copy of my pension, which is in ESG. And then it shows the client that we believe in what we're doing, but then actually talk to the client saying, no, this isn't me picking the funds. If you've got a moderately adventurous risk, which I have and my daughter has, you're going to get the same funds managed by Morningstar. So we're not going off on tangents.
And I think the third thing was that we had to get the team on board. And we had to talk to the team about these people, their values. It was really important to them. So we were going to make the way we contacted them environmentally friendly. Everything we did was going to align with the ESG principles. It wasn't easy at the start. It took a lot of time. It still takes time. We're learning all the time. But I recently watched a really good seminar by a fund manager, and then he went and got a bottle of water, which I thought was quite ironic when he was talking about an ESG portfolio. So we try and make sure everything we do is neutral, it's appropriate for their beliefs.
Okay, and another question coming in on that is, sorry. Yeah, if you really believe in ESG, why not make it obligatory for every client?
We've been working with some of our clients for 27 years, and I'm sure there's advisors listening to this who've had clients longer, families they've looked after for more. We don't want to pigeonhole someone and say you have to have this, because it's not right for everyone. It's not what everyone believes. So we've adopted an approach that we'll talk to people about it, but if it's not for them, we don't want to lose that relationship. From a financial point of view, we couldn't afford to lose all those clients. But those clients we've spent years with trust us. They trust the advisors they've been working with for a couple of decades. Just because we have our beliefs doesn't mean that they have to follow us. We still talk to them about their normal portfolios, and we run both in connection, our normal portfolios and our ESG, because I think we're going to need both to go forward. Like I said earlier, I think ESG constraints are going to become more mainstream into more portfolios, but we don't want to let those people go, and we've built relationships with them, and that would be really unfair on them.
Okay, thank you. I think we've probably got time for one last question. So, Casey, I'm going to come to you. Why is it that the three largest ESG data vendors differ substantially in their ESG assessments of the same companies, and what should advisors do about it?
Yeah, sure. That's a good question. It's one that we get very often. I would say, at the end of the day, what we do as an ESG rating and research firm is we take in vast amounts of often unstructured data. Of course, with new regulations, data is improving, quality of data is improving, and things are becoming more standardized. But as it stands now, a lot of this data is very much unstructured. So we need to interpret this according to our methodology, which is our assessment of ESG risk. At Sustainalytics, that is materiality-focused risk rating. And so I guess I wouldn't be too worried with the fact that it could be that different rating firms have a different assessment on a company. I think at the end of the day, it's important that we're transparent and that we explain our methodology so that our clients can really understand what's driving the rating and make their own decision at the end of the day, whether they agree with it or not.
Thank you. I think that's all we've got time for. So thank you, everyone, for your comments, and enjoy the rest of the conference.
Good morning and welcome back to our next session. My name's Andy Pettit, Policy Research Director here at Morningstar. And this session is going to focus on a genuinely groundbreaking piece of policy that took effect in the UK last year. It emerged out of the FCA's market study and took the form of an assessment of value, which essentially requires boards of funds to ensure that each of their funds conduct a thorough assessment of their offering and how they fared against the commitments that they set out to achieve. So effectively asking funds to do a self-appraisal and tell their investors once a year how they fared. So to discuss what those assessments have looked like during the first year and a half and how they've benefited or not investors, I'm joined by a panel of three colleagues. I'd like to introduce, first of all, Holly Black, who's editorial manager at Morningstar and one of our main touch points with retail investors. Secondly is Gavin Core, who heads Morningstar's due diligence and manager selection services business. And increasingly, his team is engaged in conversations about assessments of value with our clients. And thirdly is Andy Burton, a professionalism advisor at the CFA UK and co-author of a study in February of this year that looked at the first round of reporting. So with that, I'd like to hand over to Andy to start the session.
Thank you very much, Andy, and thanks also to Morningstar for the invitation to myself and CFA UK to speak to you today. This subject is very central to our society, to CFA UK. We are all about building a better investment profession, and the client is at the centre of that. My role at CFA UK was to convene working groups around various thought leadership topics. We've done 2 of those groups now on this subject. The first was in 2018, where we basically built a framework to on the back of the FCA regulation to assess value for money. And then we followed up with that with a review of the 100 or so reports that had been produced by firms in that year, and using that framework as a lens by which to assess the reports that have been produced. As you can see from the schematic here, we put the 7 criteria provided by the FCA into 4 of our own. One, to highlight just about presentation of reports. That was a new criteria which we created. A second was just a transfer of quality of service. Third was net performance, likewise a similar transfer. And then the 4th criteria, where we put together all the costs and charges together in one category. So I'll turn to quality of service first. And in our review, this criteria actually scored the lowest. One of the reasons for that is it's a very difficult subject to get across to retail investors. And some of the best examples of this actually use video as a media source to get their points across, and not use large bodies of text. Because you have to explain the whole customer proposition. It covers from execution to communications, ESG, which is obviously a big subject, liquidity, governance, all of that needs to be sort of condensed. And how do you best get that across to your clients? And we feel a video is a good way to go with that. Numbers are a very good way to express performance, and quality of service is much more intangible than the other criteria. But there are areas you can go to get numbers, and if those are presented annually, consistently, you can build a journey for investors which has integrity. So we like the use of customer surveys. The best reports we saw used internal or maybe external surveys. Customer complaints data ombudsman referrals, that sort of data is, we felt, also useful. And again, it could be used consistently year on year. What should improve next year was a real area, I think, where the best reports stood out. It explained to customers, how the offering is going to improve, how the firm it concerned was working for them going forward in the future, and how, this is not a static product, it is going to improve. And quality of service is the opportunity, particularly for those firms that don't have direct dealings with their customers, to sell their USP. So if you are a climate specialist, if you are an ESG specialist, this is your opportunity to say, this is the unique selling point of our firm, and to put that across to your client base and your potential client base. Net performance, on the other hand, is much more quantitative, and perhaps unsurprisingly, this section scored the highest amongst all of the criteria that were reviewed. The best reports really used a dashboard with few words, a lot of graphs, a lot of statistics. Well, actually, not a lot, just enough to get the point across. And the FCA had been more prescriptive about this particular criteria than the others. So they had said, what is your objective? You should state that. What's your performance against that objective? And how does that look? And describe your underperformance or your overperformance against that objective. So there are already some key building blocks for everyone to work with. It's useful for clients to see how their fund has performed versus peers and versus benchmarks. So the best forms also included graphs, usually with that data, maybe with a table below. Firms are explaining performance, obviously, in other documents that they produce. So again, good reports might have a link to the KID or to the fact sheet, which also demonstrates in other time horizons, perhaps, how that fund is doing. Bearing in mind the retail audience, pound and pence equivalents, really useful. It just makes it clear to the guy on the street what's happened to their investment over time. And the best reports actually put that increased return or that performance alongside the costs and charges that the fund had sustained over that period. So they could see the value for the money. And when we did our risk framework back in 2018, we talked about net performance being net of risk. So risk commentary was again something we looked at. And in the first bunch of reports, that wasn't always there to see. So costs and charges really is quite pithy, and the aim here is really not to confuse the retail client and be quite clear about what are the costs and charges, because it is an area that can be made too complex. So for AFM costs, for the OCF, the breakdown of that, just the AFM cost, and then the direct and the transaction cost. We felt those three categories were all that was needed. Some reports provided more detail, which we felt was not necessary. Perhaps you could add whether the fund paid VAT or not on the if VAT was included in the AFM fee, but otherwise we didn't feel anything more was needed. In terms of comparison to peers, that is clearly a very important area. The more independent sources is used is better. It meant that there was a belief that the firm is not marking their own homework, that they're actually getting independent voices to the table. Economies of scale, it's clearly quite difficult to for some funds to accommodate. They might be new funds, so they might be startup funds, so they can't look back at incremental savings that have already been passed on to investors as the fund has grown. So for those funds, perhaps this little bit might not be so relevant for the past, but for the future it is, because surely all funds can say something about their intention to pass on savings to investors. And that means not only savings in third-party costs, which really did come out in a lot of the reports we saw, but also potential savings through tierings in the AFM charge as well. Share classes is an area really which lends itself, we felt, to a table, very succinct, just tabulate the fee, describe the share class, the purpose it's there for, and maybe the size outstanding of the share class so that the reader gets an idea for, how big is the share class. And on comparable services, there is a real danger here that firms perhaps bamboozle clients with some of the ways you can explain comparable cost methodology. So for us, we felt those which just had a statement of fairness was probably mostly what was necessary. Clearly, it's a regulatory document, so that would need to be backed up behind the scenes, for the case that the FCA reviews what's there. So if I can close with some remarks, there's a lot of reports out there now, and as Andy has said, we're into the second reporting year, and there's now some really good examples out there. So we'd encourage you to definitely lay hands on some of those. We had difficulty laying our hands on all of the reports. So again, a piece of feedback there would be make sure that your report is clearly available on your website, a document library, for example, or sitting alongside the KID and the fact sheet. If it's HTML format, you can get it straight off Google as well. That's definitely helpful. And use of dashboards is good as well. It allows you to compare funds across, across the firm itself. And in terms of presentation, tables, charts, graphs, a chairman's statement at the beginning to add authority, and video, again, for those more descriptive comments. We felt those were the best features that we saw. So to sum up, I was actually buying a car last year at the same time as doing this, and in many ways I felt there were some things that the investment industry could learn from the automotive industry, the way they describe very technically their products on their websites, all the measurements, including CO2 emissions, for example. There is a lot, I think, for our industry to learn in terms of communication from the way the automotive industry has moved. So with that closing remark, I'm going to hand on to Holly. Holly.
Thanks very much. So I would like to talk about this from a retail perspective. I'm not standing on the right mark here, so I'll get there eventually. It doesn't help that it's the same colour as the floor. Because one of the things that the IA have heard, particularly from fund firms, is they don't really know when they're writing an assessment of value report where to pitch it. And I think the point is it should be pitched at everyone, because the more people that can understand a value report, then the better, the more we're going to get the message out there. So I wanted to start with a case study. This was a reader letter we got in a couple of months ago. This person, I'm going to call her Sarah, had been paying £50 a month into an index fund. She chose an A simply because it was the first one on the list, and it's all a bit confusing when you're choosing share classes. And then she got an email a few years later from the fund company saying, A is being closed, we can offer you D. And she was confused because she'd chosen this tracker fund because it was cheap and it had a decent rating, and she thought she'd done all the necessaries. And when we looked at this, the A share class that she was in was charging 51 basis points, and the D share class she could have been moving to charges 5 basis points. So while it's great that the fund company had made that move to change it and get her into the cheap share class, that's a few years where she's been technically overpaying for a fund, and we know what that does to returns over the long term. And if there was a value assessment at the point of buying, then arguably tens of thousands of investors could make a much more informed decision. So the IA looked at value reports and how they were going a year in. They did 1,500 funds covering 800 billion of assets under management, and there was some good, there was some bad, and there was some very ugly. So one of the most interesting things I thought was that how much the length varied. So some reports were 1 page, some were 400. I definitely wouldn't want to be in a fund where I've got to scroll through 400 pages to get to the answer of whether it's good value or not. And some included statements from the board and some didn't, and only about half actually used performance figures to assess value, which is a bit crazy really, because particularly for a retail investor, that's going to be one of the first things they look at to assess value for money. And as Andy has said, work on accessibility, making the reports easy to find really needs improving. The IA said about 11% of the funds it looked for couldn't find without using Google or a search engine. I believe the CFA's own study, it was about 25% that they couldn't find on the fund's website. So I thought we'd look through a few examples of what's going well and what isn't. I think Rathbones was an example of one that is good. I particularly liked 38 pages. That's quite a manageable size of report, and so many pounds and pence examples. Rathbones is one of the companies that has made efforts to close legacy share classes and move people into cheaper options, and they've really gone to lengths to explain how that is going to help someone and hit them in the wallet, which is how we speak to retail investors. Whenever we use percentages, it just makes everything a lot more opaque and difficult to understand. And I thought this was a really interesting example. Now, I know that a multi-asset total return fund is not a straight swap for a UK bank account, so you could argue this is not a fair comparison. But actually, I think for a retail investor, it is, because the option might be, I'm going to choose this fund that was recommended to me, or I'm going to just not bother to invest and put my money in a bank account. So having a real tangible example that anyone can understand, I think was actually a really good shout here. Improvements for the Rathbones report, maybe a little bit less text, a little bit more on the visuals, but otherwise a really good first effort. Now, Vanguard, kind of the other way. I opened this up and saw this big chart and just kind of wanted to cry a little bit. But actually, once you get your head around it, it's really easy to navigate. It is a traffic light system. My 6-year-old godson could open this up and go, yes, green good, yellow not so much, red should be worried about that. Vanguard, what I really liked as well was it defined, I mean, that's gone just in the crazy order. It defined good value in lots of different ways. So people can look at what's important to them. Is it economies of scale, or is it just the bottom line? I liked that they referenced how they'd improved from last year's. To me, that reminded me of how you now, when you get your insurance premium through, the company has to tell you what you paid last year, rather than just pretending the bad stuff didn't happen. And I really like this chart, not least because it's a shout out for Morningstar, but because you can really just see at a glance Vanguard's charges versus the category. Now, arguably, it's easier to boast when you are a cheap index fund and comparing yourself to a category that includes a lot of active funds, but it still shows that you can make this information very easy to understand. So the next one we looked at was Franklin. I guess my first question here is, why is that lady with a spider plant on the front of my value report? But then I moved on from that. And I really liked all the visuals. I think this was up there with the most visual reports, and lots of pounds and pence examples, lots of things in different formats so people can find the one that works for them. I liked that Vanguard looked at the impact of fees over the long term, because we know that over 1 year, the difference of a few percentage points isn't going to have much impact on your returns. But when we start to look at it over 3 or 5 years, that's when you start to see why this stuff is important. And my favourite thing about the Franklin report was at the end, just a little biography of each of the board members. And I thought that added a real nice sense of accountability. And for the retail investor, it says, these are the people making the decisions, and this is their expertise and why they're making the decisions. And I just think that's a nice touch. So the last one I want to look at was Unicorn, and this was dense. This was wrapped up in the annual report, which I'd argue is not a great strategy. It just makes things much more difficult to find. This one was 133 pages. I did a search of the document for the term value assessment, and it only appeared once in the document on page 131, which to me doesn't seem like a firm that's really promoting these reports. Instead, we started off with 14 pages of accounting policies, the responsibilities of the depository and the ACD, and at that point I'd fallen asleep. So really just thinking about cutting the jargon and understanding what's important to people. And that brings me on to my wish list, which I'll finish up with. I really think the first thing is to promote these reports, make them accessible, boast about them, because if you're that good, you should be shouting from the rooftops. Get rid of the jargon, make everything clear, charts, comparisons, pounds and pence, speak to people in a language they understand. Maybe some more detail on performance and objectives. That was something that some firms did and others didn't. 79% of firms concluded good value across their range, according to the IA. Now, Morningstar does a study once a year called the Active Passive Barometer that looks at the number of active funds that outperform the benchmark. I can tell you it is not 79% of them. And finally, close chronic underperformers, close legacy share classes, and help investors understand the share class where they can get the best deal. And with that, I will pass on to Gavin.
Good morning, everybody. It's very nice to be with you today. Unfortunately, I'm quarantining at home in Somerset, so I'm not able to join my colleagues. But I'm delighted to be able to talk about the assessment of value and a solution that Morningstar have created alongside Boring Money, which we hope will bring some insights and some help to the asset management community in delivering their assessment of value. As Andy said at the outset, this is a really important piece of regulation that is having a demonstrably positive impact on the asset management community. It is having a tangible reduction in fees, and it's also throwing transparency onto a relatively opaque sector of the market, which is all to the good. So when we looked at what the CFA have said and what the Investment Association are doing related to what Andrew and Holly were talking about, there's some things that we felt that we could help with as a combined solution with Boring Money. And firstly, one of the things they were highlighting was independence, and independent input was important, and also critically to have the consumer voice at the center of these assessment of values, and ultimately to try and give greater transparency, which would improve the outcome for investors and empower those investors. And so in terms of independence, it was also highlighted that firms, asset managers who were creating their own peer groups by which to benchmark their performance was perhaps not appropriate. Obviously, it's a bit like marking your own homework. If you can choose who you're marking it, who you're comparing against, that's not great. So having independence, having some structures in place that provide and ensure that peer groups are relevant and appropriate is important. And secondly, on transparency, focus on the pound costs and the implications, the tangible implications for investors of being in overpriced funds or share classes, or the wrong share classes is important. So focusing on costs and focusing on the share classes. So Morningstar and Boring Money are two businesses that, whilst entirely different or very different, also have some common aims. And the aim is to try and shine a light for the end investor into the world of investments. And so Morningstar are a large independent data analytics and research firm, as you will know by implication of joining today. And what we have is a lot of quantitative data, and we can evaluate that data qualitatively through our research teams. Boring Money bring the customer voice. So they survey 1,700 investors every quarter to determine what their perception of value is and their perception of service is. As we all know, perception is everything. And if investors have got a perception of value or service that is different to what the asset managers believe, then that is an important thing for them to at least consider and perhaps address. So we feel that by bringing the two of our skill sets together, we're able to ultimately benefit the end investor, but help the asset managers in trying to do that. So what do we do? Well, firstly, we are independent, both of our businesses. So we don't have any conflicts of interest or incentive structure from the asset management community. So we're bringing entirely independent input to our inputs to the asset managers. We have extensive data. We also have the qualitative assessment of that data. So whether it's performance or charges, we're able to evaluate that data and determine whether it's good or bad. And we have multiple ratings lenses. So through Morningstar's research and analytics, we can look at things from a backward-looking risk-adjusted performance metrics to forward-looking ratings to sustainability ratings, which we think will become increasingly important. And related to that, forward-looking evaluation. So it is obvious that asset managers are evaluating their performance looking backwards. What we're trying to do is to help the investors make a judgment on that performance by bringing contextual reference points to it, to make a judgment as to whether that performance is good considering the market environment that we've just been through. And the solution is very flexible. So what we're trying to do is enhance the assessment of value process. We're trying to bring better insights and bring that independence, which we think ultimately will be important for the assessment of value that the asset managers are giving, but it may raise the bar in terms of people's confidence in those. So I won't go into all the details here, but we have a lot of peer group through our Morningstar categories. We can help make sure those peer groups, as I mentioned, are appropriate, that there's no manipulation of the peer groups to come up with a better number. We also have a lot of data around economies of scale and costs, which we can provide insights on. And we can also provide the contextual performance data that I mentioned. So whether the fund is a value fund or a growth fund, small cap or large cap, we can provide the context by which we judge those funds. And then the customer viewpoint is provided by Boring Money. So obviously through their surveys, they're coming up with a perception of that quality of service, whether the consumer and the investor feels the performance is good or bad, and whether those costs are reasonable or not. So I mentioned the forward-looking view. This is a busy slide, but just it demonstrates the fact that we're bringing an awful lot of our analytics and data to bear when we look at the performance of a fund. So we want to say that if a fund has had a bad period, whether it's over 1 year, 2 years, 3 years, and the asset manager is making a comment on that, what we want to try and do is to bring that understanding of the environment they've been operating in to help provide an input to see whether, given that particular environment, given the trends and themes and styles that were prevalent in the market, that those funds, that fund's performance is actually good or bad or of concern, but put in the context of where it's operating, and critically, particularly relevant and related to what the objective of that fund is. For example, if it is a value fund, it is an explicit value fund. If it has had a difficult environment because inflation is low, as we saw between 2016 and 2020, that is an environment where value funds did particularly bad. So we want to judge those funds related to the environment and related to the peer group that we think is appropriate to them. One of the final points I wanted to make was around ESG. So as we all know, this is becoming incredibly important, not only from a regulator's perspective, but also from the consumer's viewpoint. The consumer is changing in terms of its preferences and its desires, and ESG is increasingly important to them, and ultimately via the regulators to the advisors and the asset managers. And so Morningstar and our sister company Sustainalytics have put ESG at the heart of our research. We have an awful lot of ESG data from the bottom-up company analysis through to the fund level analysis and ultimately up to portfolio analytics. And we think ESG is going to become probably an 8th pillar of the assessment of value. So with Boring Money, we have also included in our solution to asset managers and our input to them an ESG pillar. So here, once again, we take Boring Money's survey data where they do a survey of what the investors think of that particular fund house in terms of its ESG or sustainability credentials. But we do the underlying data and analytics. So we look at the fund's holdings through our company analysis from Sustainalytics research analysts up to the portfolio level through our aggregation of all that data. And we determine how that each one of those funds and each one of those share classes compares to their peer groups on a number of different metrics across ESG, whether it's particularly focused on the environmental element at the moment, but increasingly as it becomes important to investors on the S and the G as well. And so we can use once again, our ratings and our analytics and our globe ratings, which you will see on the Morningstar sustainable rating on the right-hand column. So bringing that all together, we can not only make a judgment on the existing 7 pillars of the assessment of value, but we can also provide that insight as to how those funds and those share classes stack up from a sustainability perspective. So what we're trying to do here is we're trying to help the asset managers provide greater clarity, greater transparency through an independent input to help them with their assessment of value. To be clear, Morningstar and Boring Money are not making that assessment of value judgment ourselves, but we're providing them with tangible data, an evaluation of that data, and a customer perception, which will help those boards of the asset managers and the independent INEDs of those boards to focus on areas of concern so that they can tangibly focus in on some of the problem children within those fund lineups. So we're providing them with the tools, the insights, and the data, which will allow them to focus in to try and improve where there are problems. And we hope that this will give a comprehensive input into the asset managers that will ultimately result in a better assessment of value solution across the industry. And I'm going to stop there.
Thank you very much, Gavin and Holly and Andy. So you'll be delighted to know that we have a few questions. Perhaps coming back to you, Andy, first of all. There's been calls at different times that suggesting the FCA should be more prescriptive in their formatting of these reports. Do you think that's needed, or is the free form open to more innovation? And
well, actually, when we produced our report, we concluded that that the FCA should provide more prescription. But as I've seen some of the reports come out this year, I'm beginning to change my mind on that. I think they've been doing a lot of work behind the scenes, talking to funds, and some of the results of that, I think, are really encouraging. And by pushing the responsibility onto clients, it's empowering them to produce perhaps reports which are better for their fund. They know their funds best, so they are in the best position to describe them. So I'm in two minds about that at the moment.
Okay. Gavin, perhaps coming back to you, presumably this is not an insignificant cost for asset managers to produce. But do you think it's a worthwhile cost, and will it ultimately benefit investors?
So I think the asset management community, unsurprisingly, have probably been dragged into doing this, of course. Probably they wouldn't have put their hand up to volunteer to do it. What our feedback from the asset managers we've talked to is that this has been a very difficult and arduous process. It is something they've had to come to relatively new. It involves multiple parts of their business, from product to fund management to risk, to governance. So it's dragging in a lot of people where this hasn't been the day job. And I think that was probably reflective in the experience that we witnessed in the first year's reports. But as Andy has said, it's resulted, I think the second year, obviously that has improved as they've got used to this process and have tried to put greater structure in there. But it has involved a considerable amount of cost. I think I can't come up with a number, but certainly a considerable number of the asset managers we've talked to are now beginning to think of this as a positive process and something that they want to embed into how they look at their product lineup. So not just use it as a reporting mechanism and structure, but actually use it to consider whether they need to restructure their product lineup, whether they need to improve their messaging, or change the market that they're actually serving.
Great, thank you. So perhaps one last question to Holly. You alluded to both some of the benefits that have already been seen and also the fact that very few funds have been called out as poor value. So do you think the quick wins have been had, and do you think much will change in the future rounds?
I'm hopeful that more will change. I suspect that some funds in the first year, particularly those who were among the first reporters, maybe didn't want to come out and say our funds are not good value because they were worried that their peers would. And maybe now they've seen that some firms are being brave to make change and close share classes, that they'll be encouraged to do the same and act in the best interest of investors.
Great. Thank you. Well, we're up against the clock, so just one last thanks to Andy, Holly and to Gavin, and hope you enjoy the rest of the sessions today. Thank you.
With the US equities recovery underway, I'm sure many of you have been wondering whether the value rally will continue and where the best investment opportunities are at the moment. To answer these and other questions, we have Claire Hart from JP Morgan Asset Management. Claire manages the JPM US Equity Income Fund, which is rated gold by Morningstar and has 28 years of experience in this space. JPM US Equity Income happens to be one of the largest strategists managed by a woman at 65 billion total AUM. Claire has been following US equities for many years and is well positioned to bring perspective to this subject. Please welcome Claire Hart. Please welcome Claire Hart. Apologies, we had a technical issue, but we will be with you in 3 minutes. Thanks for being patient with us. Here is Claire Hart.
Thank you for your time today. My name is Claire Hart. I'm one of the portfolio managers at JP Morgan. I thought I'd spend our time together today to talk a little bit about the US markets. So if we think about the markets for last year, 2020, we definitely saw a dramatic preference for growth over value, broadly speaking. Growth actually outperformed value by quite a large margin. And if we think even more specifically about the undulations throughout the market in the year, there were times when value seemed to be pulling ahead, growth pulling ahead, but at the end of the day, growth dramatically outperformed. So the way that I'm looking for stocks in the market, we have a bias towards quality companies at reasonable valuations that pay a dividend yield. And so my comments today will probably be a little bit focused around those sorts of companies in the market. And from our perspective, we think there's lots of opportunities. So if we think about, again, sort of this opportunities from last year and what we're seeing this year, we take a little bit of a tour through the US markets. I might start with the financials. And I start with the financials for a few reasons. Certainly, as we're sort of living in the aftermath of last year, the activity we're seeing in the market is much different than what we saw during the financial crisis. If you remember, 2008, 2009, it sort of started the financial crisis sort of started obviously with the financials and spread out from there. It was sort of a slow bleed, so to speak, across the sectors, and the impact last year was quite dramatic, and it wasn't really centered in the financials. That being said, there's a lot of opportunities in the financials last year and even this year. I make this point because as I think about the financials and the opportunities we see in the market, it's not one specific subsector of the financials. In my mind, if I think about the opportunities, it's always sort of the weight, the risk and the opportunities. It's spread across the sector. So for us, the financials breaks down nicely into different buckets, such as the banks, the diversified financials, which might be sort of your credit card companies, with asset managers, insurance. And then within insurance, there's property casualty names, there's life, and then there's obviously the brokers who aren't taking underwriting risk at all. So within the financials, lots of opportunities, lots of different subsectors where you can look for different risk and different opportunities. So for us, just as a few examples, we have something like a Morgan Stanley. Morgan Stanley, which 10, 15 years ago might have been very focused on investment banking, which is hard to predict as an earnings stream and so hard to put a multiple on. Fast forward to today, a greater preponderance of their earnings are related to asset management. And we like asset management as an industry. There's the sort of the consistency of being able to deliver in terms of value to their clients, rewards to their clients in terms of performance. And that sort of takes a lot of the volatility out of the earnings streams from the other parts of Morgan Stanley as a business. So we do like Morgan Stanley. Someone like an American Express, for example. Again, if you think about sort of last year, and the opportunity to get a position in the stock coming into this year, American Express was in a bit of a storm. If you think about people not traveling, not doing business travel, not going to hotels for vacation, all of that was related to sort of impacting American Express in terms of people not using the cards. But as we think about American Express as a franchise, and we think about the reopening that we're seeing, we are seeing that obviously business travel is not quite back to what it was. It might not get to the levels it had been for a long time, but American Express is very well positioned within the consumer, who is now continuing to sort of pull out the card and maybe try and go places and do a bit more spend on their cards. And the next leg, so to speak, will be the travel and entertainment when that bit comes back. And in the meantime, American Express has done a great job managing the credit, sort of the costs related to the credit they extend. Maybe one last financial would be somebody like a Citigroup, where again, if we think about the different things that can impact a bank, we have credit, and the credit has been quite good at Citi. If we think about the previous financial crisis and the difficulty some of these large banks had in navigating the financial crisis, they've done a much better job in this crisis. And so again, Citi is a good opportunity for us. When we were able to take positions in the shares, it was trading below book value with a book that we felt was not in question. So if maybe we take another sector, so to speak, move to something like the industrials. So within the industrials, again, lots of different opportunities. For us, there's something like, for example, a Deere, which you may or may not be familiar with. They manufacture farm equipment. But the beauty of Deere, for us, Deere is not about corn price. Historically, again, you go back many years, the corn price would be something that would drive the demand and then drive the cash flow and the profitabilities for farmers and impact Deere quite directly. If you fast forward to today, Deere is offering extra value to their farmers who buy their equipment with their precision ag. And what this does, it's technology, and it's unique to Deere and their equipment. And it allows the farmer to reduce the amount of spray. Instead of spraying a whole field, the precision ag can show them where specifically they need to spray to control for a pest, so to speak. And it can offer them sort of an optimized vision of how often should they plant something. And all of this is also done with less people. And so in this way, Deere is able to sort of bring some technology to the farmers to enhance their yield and their crops. And from Deere's perspective, increase the cash flow and the profitability for all of the machines that they're actually selling. If we move to something like a technology for us, even though we're looking for quality companies with yield, and you think about the US market, certain technology names might come to mind because they're in the press quite a bit. But for us, we're able to find things like Analog Devices and Texas Instruments. Now, these are equipment names, semiconductor names. They're not top of mind, but for ADI, for example, if you are driving down a highway and there's a certain class of Mercedes that's driving at you, and you notice that the lights tilt ever so slightly down and away out of your eyes so you're not blinded. That's ADI's sensor that's in that very expensive Mercedes, helping the driver not blind you in oncoming traffic. Now, obviously, that has great benefits to everyone who drives, but specific to a very specific model of Mercedes, it's a very small cost for ADI for that sensor. So, and ADI does that in many ways across many industries. My point is, for a very small input cost on a very expensive car, ADI is able to partner with the car makers and charge a reasonable price for the sensor. But once that sensor's in the model and it's working, the car companies are not coming back to negotiate for a 3% price cut from ADI. They're just glad they've got a sensor that really works. So within technology, that's an example of a company, again, I think not top of mind, but we're finding opportunities like that. And there are many different names like that in the technology space, even though you might only hear about the top, call it 3 companies. There's lots more, and lots more to see, I would say, in the US. Maybe lastly, just on the consumer, going back to my comments about how was last year different than the financial crisis. Within the consumer space in particular, for the consumer names, and again, this is sort of maybe most directly focused on consumer discretionary and retail. Last year was an acid test for business models, management teams, because all of a sudden, globally, stores were shut. And a company might have been saying that they had really good online servicing and really good direct-to-consumer delivery, but last year really proved if they did or didn't. And so from our perspective, we were able to sort of capture and bring into the portfolio some new names where they really proved that they had a better management team, a better business model, better online servicing that maybe we had realized. And again, we realized during the crisis, these people were actually able to deliver. And we realized there were some real gems there. So for us, these would be names like a Cisco, for example, which is a food delivery company. So obviously it was very difficult for them when all the restaurants and the dining halls and the dormitories shut and people didn't really need large quantities of foods delivered because people weren't coming out to restaurants. Cisco was able to navigate it. And again, in a very difficult time, that management team proved themselves to us. Someone like a Gap, for example, again, a brand that someone might take a look at and say, is it really a great management team? Do they really have brands that people want? Gap was able to navigate, again, all of a sudden, all their stores being shut, but be able to deliver their products to people and able to navigate it with their balance sheet navigate it with the management team, and come out really well. And we think that Gap is one of those few select retailers that are going to be able to navigate in the future against something like an Amazon. Maybe one last example would be somebody like a TJ, which is obviously TJ Maxx, the clothing store. Again, they don't deliver by email. They really need you to come into their store, to go through the racks. It's the whole idea of a treasure hunt. That being said, TJ's business model was able to navigate having their retail outlets shut, again, globally, for a fair amount of last year, and then reopening this year. And not only reopening in style, because lots of the companies, unfortunately, retailers that had gone bankrupt had inventory. And one of the biggest issues for TJ historically has been, can they get inventory? Can they get enough things to fill their stores? And they're having no trouble with that, obviously, now, because there's lots of stuff out there for stores that have been forced to shut. TJ is even a company, I would make the point, we didn't have a tremendous amount of dividend cuts, so to speak, but TJ is one of the ones that suspended their dividend, which is an appropriate use of capital given that their stores were shut. But then the bright side is once they actually did reinstate that dividend, it's actually quite healthy again. So the maybe last sector I would talk about, because it is topical, and I think you're hearing a lot about it now in the States, we will continue to hear a lot about it, would be healthcare. This current Biden administration is very different from the previous Trump administration in many ways. Specific to healthcare, I would say one of the things that surprised us a little bit is when Biden came out and talked to the World Health Organization about potentially relaxing patent constraints in the US related to the vaccine. Having spoken to many of the pharma CEOs and actually some medical device company CEOs, that is not something that we would expect to continue, meaning I don't think the Biden administration is going to go about attacking US patent law. But what it is a good reminder to us is this is a different administration. They have very different views related to many things, but specific to healthcare, making healthcare affordable, making it accessible. And a lot of the pharma and med tech and managed care companies trade under a lot of pressure because people don't know necessarily how it's going to change. But from our perspective and talking to it with the management teams, it's a new administration. They feel they can work with them. And broadly speaking, more people being covered is good for the managed care device companies and the pharma names. So again, I mention it because I think there's going to continue to be a lot of conversation related to the healthcare space. Drug pricing is something that comes in and out of the conversation at times. Again, affordable healthcare comes in and out of the conversation. For us, having a name like United Healthcare, for example, as a managed care provider is, in our opinion, one of the strongest, if not the strongest, managed care company in the United States. And so they are more likely to be partners, and that's how they see themselves. Partners to getting more people enrolled, to having people have greater access to healthcare, rather than be at risk if there's a change in the market, because they have the flexibility, both in the business model and their financials, to make changes if they need to stay relevant to the market. So I might just end my comments there broadly, and then I think we're going to open it up for Q&A.
Thanks, Claire, for such an insightful presentation, and apologies for technical issues again. And now we have time for some questions. So do you think the US market has changed in terms of equity income investing over the past decade? And what opportunities does it bring? For example, are traditional income areas still the same or changed?
Well, thanks for your time today. As I think about the market in the past decade, I think a lot has changed. I mean, one of the first things that probably comes to mind if I think about it is there's more opportunities within technology. And that's an area that continues to broaden out and give us opportunities, I would say, in terms of more subsectors. And then beyond that, what's really changed in the past decade has been the consumer. And you would see that if you looked at the equity income portfolio, call it 15 years ago, and then you look at it today, what you've seen, I think, is a gradual change. And that's based on where the consumer is choosing to spend their money. One person's consumer staple is now someone else's discretionary. And so those two areas jump out at me. And actually, now I think about it, the third one, probably healthcare, because in the past decade, the United States has made, we've heard more about it, sort of the move through the Obama administration, a move to cover more people. And so as more people are covered with healthcare in this country, where that healthcare money gets spent in the chain in terms of managed care names and the pharma names and that sort of thing, that's changed as well. But those all, from my perspective, we've opened up opportunities, sort of small subsectors for the portfolio for equity income.
Thank you, Claire. So the next question, how are you preparing your portfolio for inflation and interest rate hikes?
So inflation, that's a good one. So I would say, how are we prepared? As we think about inflation, just as a step back in terms of what we're hearing from companies, when we talk to companies broadly across the board, they're talking about it and they are seeing it. And so it depends on the company, but we are seeing higher transport costs. Obviously, commodities, input costs are going up. There's shortages throughout the supply chain. And that's a bit of, I think, a backdrop, a bit of a lag off of what we're seeing last year. And of course, labor, wages. Labor is tight, getting tighter. Our unemployment rate is hovering a little above 5. It had been, closer to below 4 before the pandemic started. And so labor is getting more expensive. And what we're hearing from companies, all these input costs are going up, and they will say, we're taking price and we're getting price. So that's great from the company's perspective, but to the point, we're seeing inflation, and I think it's coming, and it's going to come to stay. So I would say broadly for the market, as long as it's kind of measured and comes in not dramatically all at once, that's good for the economy, because consumer names, for example, within the consumer space, our companies can take price. They need a little air cover. They need some inflation to be able to take price. So that's a good thing. In terms of how we're positioning the portfolio, I would say directionally, our banks, for example, we have a fair amount invested in the banks, as discussed on the video. That's an area where we definitely think we're going to see more demand for loans. And I would say rising interest rates is actually good for the banks. They can make money now, but they can make more money if the yield curve were a little more cooperative in terms of rising rates. So those are areas where we've made some money. We continue to think we'll see money. And then on the inflation, some is good, too much is bad. So that's one thing that we're watching for, just to make sure, again, it's a bit measured in the way it comes in, and just to be sure that we don't get caught offside, so to speak.
Thank you. What are the key challenges for U.S. equity income investing at the moment? For example, concentration risk relative to S&P 500 with growth funk stocks dominated. What is your view?
So I would say one of the key risks for us versus the S&P 500 would be to the extent what we saw last year, if it's very growth dominated, or some of the lower quality names, highly levered, responding well as the economy reopens. So on a relative performance basis, I would think it's that there are parts of the S&P that, again, without the earnings power or the ability to pay dividends, these companies are outside our area of scope in terms of investing. Now, I don't see that as a problem in terms of investing, because I do think there's lots of things we can buy in the market relative, for us, for our mandate. That being said, if someone's looking at us versus the S&P, the risk would be some of the technology names or the healthcare names or the low quality names continue to have, very strong results, because people are excited about the reopening or don't care that interest costs are eventually going to go up. So on a relative performance basis, that would be, how we would have weakness against the S&P.
Yeah, sounds good. Thanks, Claire. And what are your views about the growth versus value debate? Is the value comeback going to last, in your view?
I think, from my perspective, I do think we're at a point in the market, not just in the United States, I think, but specific to the United States, we're at a point where everybody, I think all the companies are going to have to really prove themselves. And so there were some highly levered companies that, or business models, subsectors that people thought might go bankrupt if the pandemic had continued. The pandemic didn't continue. Luckily, we had some vaccines, so we've recovered. So I think the idea of having that kind of a recovery play, so to speak, those names are, I think they're kind of played out quite a bit. So at this point, it's going to be show me the money. So the companies are going to have to prove that they have business models that can be that are sustainable, or that they have a, you know, very basic good product service that people want and will want more of. Because the idea of, you know, these companies just sort of showing up and being there for the market to reflate, I think that trade's a bit done. So I would expect from here, we're going to see, not just for equity income, but even other parts of the market, the companies that really dominate their space, that really have a new innovative technology or a new approach and that sort of thing, they're the ones that are going to sort of pull ahead. And the second and third sort of strongest, or the not quite the best, I think are going to start to lag.
Yep, sounds good, thanks. Lots of questions are coming in. So do you think US equities are overpriced, or do you think, you know, particularly technology valuations can keep on growing?
Well, I guess the overall market has obviously had a great move, and the multiple is not as low or as cheap as it's been historically. It's been cheaper in the past. I would say this kind of gets to my comment around make sure you've got your company has a real business model and real earnings power and earnings growth to come. I do think there are parts of technology might look expensive, and parts of, I would say any part of the market's going to look expensive until they prove, you know, I always think, you know, PE doesn't work for many names in the market. And it's part of it is because people have to have the vision to understand, you know, and the modeling and the understanding of the business to see where the earnings can go. So for some, you know, technology names in particular, they're 5 years from now, some of the names probably won't really be around. And it's all about, you know, picking the winners for some of these technology names that have done well. But I would say, you know, even in our portfolio where we're not kind of, obviously don't have a tremendous exposure to some of these, the technology names that have had tremendous share price moves in the past year or two. I mean, our names like ADI, Texas Instruments, they've done well. I think it's all about, are they bringing a new technology or a new product or service to people? And if they're not, then it might be this year, might be next year, but the multiple compresses and there's not the earnings there to support the price.
Thank you. What do you see happening to the strength of the dollar in future years? It's a little bit macro, but.
So the strength of the dollar, so the way I think about the dollar in the portfolios is two ways. First of all, one way for, you know, I would say I believe in the strength of, I'm glad I get paid in dollars relative to other currencies globally. So that's, you know, from a personal perspective, but beyond that, I'm not really trying to take bets about the strength of the dollar. What I care more about is, can my companies spend money and invest globally in the appropriate way? So, you know, I'll pick on Coca-Cola, for example, or J&J. Are they navigating the currency risk appropriately? Are they navigating and deciding where to invest? You know, and how are they handling the currency risk? So that's how I think about the dollar, strong or not, because I'm not really trying to navigate and push the portfolio into an area depending on an exchange rate.
Yeah, thank you. And what comments would you make on the trajectory of the NASDAQ?
I don't think I really have commentary on the trajectory of the NASDAQ. I think, you know, wherever the NASDAQ, you know, might be, my gut says there, regardless of that, there are going to be some real winners in there, and there'll be some real zingers or some not good winners or whatever. I don't know how you say that in the UK, but there will be some companies that you'll be, you know, if you could pick the 5, you don't need to know what the NASDAQ's going to do. You just need to know who are the ones that are really going to navigate the next year or two. So regardless of sort of the overall NASDAQ level, it would probably be down to just a couple of leaders, I would say.
Sounds great. Thanks very much, Claire, for your time, and much appreciated. Thank you. I know it's very early in the US, and I appreciate for your effort dialing in.
Thank you very much.
Hello and welcome. My name is Martin Coyle, Head of Business Development for Morningstar Investment Management Europe. Welcome to this session, Emotions are Information, Balancing the Head and Heart in Financial Trade-offs. It is with great pleasure today to welcome a really good friend to the UK who has appeared several times on our webinar programs here, Dr. Sarah Newcomb, Director of Behavioural Science for Morningstar. Welcome, Sarah.
It's great to be here. Thank you so much for joining this morning. These conferences are so full of incredible insights. I always end up wanting to go and change my portfolio up a little bit after listening to the speakers. But for this talk, we're going to switch gears a little bit from looking at analyzing investments themselves, and we're going to talk about investors. And one of the big reasons why we need to do this, as any financial advisor will have experienced, is that you can often give people a really excellent plan, financial plan or investment plan, and then watch them do nothing with it. And it can be a very frustrating experience for financial advisors to put together a very logical, very straightforward plan that will clearly make their clients money, and then watch their clients not be able to act on that plan. But I think that one of the things that really happens that we don't often get trained in when dealing with finance and investment is that we need to be able to understand the emotional trade-offs in addition to financial trade-offs. And so this talk is about how to gauge and for lack of a better term, measure emotional information, and how to work with clients in a way to be able to understand how their emotions are influencing their financial decisions and how to work with that instead of against it as their coach and advisor. So let's first talk about what we're going to do here. So first we want to talk about why emotional trade-offs are a necessary part of cost-benefit analysis, a necessary part. You know, I talk to advisors who feel very frustrated by people who can't just look at numbers and be convinced by numbers, but actually emotions are a part of the cost-benefit analysis. And I'll explain to you why by going back to basic economics. We'll talk about how to uncover emotional themes in money messages and beliefs, and how to listen for those and be able to start to clue into what your clients may not even be able to recognize about themselves, but you can learn how to listen for the right information. We'll talk about the connection between needs, strategies, and emotions. We're going to blend economics and psychology into a model of understanding financial trade-offs more holistically. And I'll give you a very simple process for finding financial strategies that balance the head and the heart. Simple, not necessarily easy, but it is simple and easy to start working with. So let's dive in. We'll first talk about what is utility. We're going to go back to basic economics, and then we'll talk about emotions and financial trade-offs, how to listen for emotional information, and then how to coach accordingly based on emotions in client mindset. So first, what is utility? This is a term that we hear often. Utility comes from basic microeconomics. And in microeconomics, you will see something similar to this graph all the time. This is a basic utility optimization problem. And it's basically saying, look, the diagonal line represents trade-offs. And a bundle of goods. You have good A and good B, and each one gives a certain amount of utility, and the combination, how much of A and how much of B is optimal for this particular person, is found by the curved line, which is the person's indifference curve, meaning it represents their preferences or their total utility based on their unique traits. Now, the thing about utility that I think we forget when we start thinking about financial planning is that utility is not the same thing as money. It's not the optimal financial trade-off here. Utility is not defined in dollars or pounds. Utility is defined, utility as, it's supposed to say here, but utility is defined as the total value that you get from a trade-off. It's the total outcome, the value of the outcome to you. But value includes emotional. It's the definition of utility, if you look it up, says basically your well-being, the total value and well-being. And so emotions are actually a part of utility. Utility is the sum total of what you get as the result of a trade-off. So we can't ignore emotional information when we're thinking about total utility, because utility includes emotions. Utility, for all of our mathematical exactitude and how specific and how technical this graph makes utility look, in its very core and its very definition, utility is actually a very squishy concept that's hard to measure, because it has to do with emotions as well as finances. And so to estimate utility, one really simple way to think about it is this. You can have trade-offs that lead to a certain positive financial benefit, and then maybe there's also a positive emotional benefit. And your total utility is the financial benefit plus the emotional benefit. So let's say that you have a particular investment strategy, and that gives a certain financial benefit, and it fits very well with the risk profile, the risk tolerance of your client. Then they get a positive emotional benefit as well, because they enjoy getting the returns and it fits very well with who they are as a person. And so their total utility is large. Now, and their total utility is greater than their financial benefit, because it also includes an added emotional benefit. But that same financial benefit given to a different person who is extremely risk averse. Let's say this is an aggressive investment strategy, and this person is extremely risk averse. There may be an emotional cost. So it's a negative, it's disutility, emotional disutility, and their total utility is less than the financial benefit, because when you bring in the disutility of the emotional pain, it lowers the overall utility of the transaction. So we need to recognize that that emotions can either add utility to our function, to our cost benefit function, or subtract utility, because you can get utility or disutility from a financial strategy. And when we think about the financial decisions in people's lives, every single major financial event tends to be a major emotional event. So let's think about, buying a car. I mean, look at any car commercial and tell me there aren't emotions involved in what car you choose to drive. They go into your sense of identity. They hit all the emotional buttons. Some people are extremely utilitarian in their choice of vehicle, but most people have some emotions involved. Then you have the expenses of caring for that car. Those have emotional trade-offs. All these life events, these financial events are all major, or life events are major emotional events. Marriages, divorces, luxury vacations, or buying that dream boat or car or home. Choosing to have a family, how you travel, what you do with your time and your home, all of these things, these are major life events and therefore major emotional events. And what we do with our money translates into what we do in our life and how whether or not we realize our hopes and dreams. And so there are emotional trade-offs in every financial decision. And so we need to understand whether the emotional trade-offs are providing added utility or disutility, so that we can understand why someone might look at a financial trade-off and still say, it's not really for me. You need to understand what's happening emotionally so that you can add that to the utility equation and find the right approach for them. Now, we're familiar in doing this with risk tolerance. We are familiar with understanding how to say, you can, this portfolio will make you a lot more money than this portfolio over here. But if you're not suited to volatility, then there's too much disutility there. And this may not be the portfolio for you. We have adjusted our thinking when it comes to financial advice beyond numbers. We've come to understand that numbers aren't everything. And the goal here is not to turn people into robots that can just follow the math. The goal here is to make the math and the numbers support human thriving. We want to help people make financial decisions that really help them thrive, both financially and emotionally. We want to hit on both elements. So we don't want to ignore emotions. We also don't want to be entirely led by emotions. And so we want to properly weigh emotional utility. And so understanding when someone is being emotionally driven is good, so we can sort of bring them back to add some logic, and understanding when someone may be not taking emotions seriously enough is another thing we want to do. So let's talk about listening for emotional information. And for this, we're going to go to basic psychology. So money means a lot of things to people. It means security, power, stress, safety, success. And depending on who you are, how you've experienced life up to this point, you may have very different feelings about what money is, what money represents in your life, and that will affect how you feel about different emotional and financial trade-offs. So people's beliefs about money itself will definitely affect how they feel about different financial decisions. But we also have stories and our values, and these carry emotional charge. So people are walking around with different stories in their head, and you'll hear them in client meetings saying things like, or you can tell through their behavior that for one client, money is a measure of success. One client may be willing to sacrifice their own financial well-being because they believe that a good parent pays for college. I heard a friend say, a king is only as grand as his castle. And I thought, wow, now there's a loaded money message for you. This is an old one. A lot of people are under stress. They can't afford to get sick, change jobs, take a risk. That's going to affect their financial decisions and what they're open to and what they're not open to. Other people will really just say, look, it's just money, and use that as an excuse to spend it irresponsibly. So the stories that people carry inside their head they really contribute to the emotional utility of different trade-offs. So I like this one too. I'm worth it, which can be a great affirmation, and it can also be a great excuse to spend money irresponsibly. So let's look at basic psychology and Maslow's hierarchy of needs, because often when people are teaching money management, they will talk about, well, you need to know the difference between a want and a need. And this is actually really misinformed, because when we look at things that way, we tend to basically say, well, the only things that qualify as needs are survival needs. If you don't need it to survive, then it's a want. And so therefore not justifiable to spend money on. And that really leads to very uncomfortable, unhappy people who budget very austerely and end up feeling deprived, and then they break their budget. And this is why most people hate budgeting, because we say that we only need, that needs only qualify as our physical survival needs. But what we've got here in Maslow's hierarchy is not Maslow's hierarchy of wants, it's Maslow's hierarchy of needs. These are needs. These are all the things that a human being needs in order to thrive and self-actualize. And so yes, physiological and safety needs are needs, but love and belonging and respect and recognition and friendship and personal growth, these are all needs. And so with every financial strategy leads to either the meeting is an attempt to meet one of these needs. And I'm going to say that again. Every financial strategy is an attempt to meet one of these basic fundamental human needs. Even the most irresponsible financial strategy is someone's attempt to get a basic human need met. It may be a totally bad attempt, but that's what it is. And when a need is met, we feel positive emotions. We get utility from that. When a need is not met, we feel negative emotions and we have disutility from that. And so we often use financial strategies to meet emotional needs. And so what we want to do is listen when people are talking about their financial strategies, no matter how irresponsible they seem, listen for the need that they're trying to meet. So things like club membership, their health club membership. Are they trying to meet the need for health and physical well-being? Are they trying to meet a social need for connection? Is it an esteem need for status? Is it belonging that they're looking for? What is the need that they're meeting by their club membership? That will really help you understand when you're talking about trade-offs and what you can afford and what you can't afford. It will really help you come up with new strategies that meet the same needs. And so that's what we're going to start to talk about, is how do you coach people based on emotional information about what they're trying, about their needs? How do you coach them into great financial strategies that are good for their money and good for their heart? So coaching mindset. First of all, we need to strike the right balance between the head and the heart when we talk about financial trade-offs. So we don't want to be completely analytical and we don't want to be completely emotional. We want the wise mind. The wise mind is in between. It considers the emotional trade-offs and it considers the financial trade-offs and it properly weighs them and finds the right balance. So let's talk about something you can do with an overspender. All right, this is a very, very simple exercise to put these concepts into practice with an overspender. First of all, you ask them, think of the last time you kicked yourself for spending, because overspenders, we will overspend and then we do feel bad about it later. So last time you kicked yourself for spending, what were the needs that you were trying to meet? Because this really acknowledges that that financial strategy, as irresponsible as it may have been, rather than shaming a person for irresponsibility or just telling them they can't do this anymore because the numbers tell them they can't, understanding what were the needs that they were trying to meet when they did that. And really listen, what are those needs? Because those are needs that have to get met. They have to get met or a person is going to be unhappy, unfulfilled. And then what needs did you sabotage or threaten? Because ultimately, if you kicked yourself, there were other needs that didn't get met as a result. So you may have gone and met your need for fun and adventure by a spur of the moment weekend trip and travel, but the needs that you threatened may have been your long-term security and feelings of safety in having a safety net of cash in your bank account. And then being able, once you've acknowledged the needs that you were trying to meet and the needs that you did meet and the needs that did not get met, then you've got everything on the table. Here is your set of needs. Now, how could you meet all of those needs for the same price or less? And now you've got a creative problem-solving task ahead of you. And this is when budgeting and money management actually becomes fun, because instead of saying, let's make a plan for how I'm going to meet my physical needs and ignore all my emotional needs and feel deprived as a result, we're saying, let's make a plan for how I am going to meet all of my needs, my security needs and my needs for fun and adventure. How am I going to thrive while also not breaking the bank? So you think about the needs, where do they belong on the hierarchy, and rather than ignoring the things higher up on the hierarchy, we say, well, maybe we could use some strategies that are non-financial to meet some of these needs? Or can we combine financial and non-financial strategies to get all of our needs met? So I did an exercise once with a group of financial advisors and asked them to think about a particular spending issue that was causing strife with one of their clients or with themselves. And one advisor offered an issue he was having where he was struggling between him and his wife over the cost of his boat and how much he was spending to go out on his boat. And when I asked him about the needs that he was meeting by going out on his boat, he talked about the sun on his face and the wind in his hair. And you understood that you can't tell this man that he can't go out on his boat. You can't tell this man that he can't afford this boat. Because yes, he can survive without the sun on his face and the wind in his hair. But how much would his quality of life drop? Significantly. And so we often will do this. We will search for ways to make the numbers work, but people's lives don't work. And we have to figure out ways where your numbers work and your life works too. And so I think that the goal here is to focus on needs first and then get the numbers to support the needs. But first, you focus on the needs. So here is this man meeting his needs for self-actualization, for feeling like he is living his best life. He's out on the water, he can smell it, he feels it on his face, the wind in his hair. He is living his best life. But it's causing stress between him and his wife because she's feeling her need for security and safety is not getting met because she wants to save this money. She doesn't want this money to be going off on paying for his boat. She's feeling her need for security is not being met. And so there's a real conflict here because her basic physiological and safety needs feel threatened for his self-actualization needs. So rather than saying, well, we sacrifice his self-actualization for her safety because it's down lower on the pyramid and so therefore it's more important. Remember, it's not a hierarchy of wants, it's a hierarchy of needs. And by the time Maslow died, he was not convinced it was a hierarchy at all. So these are just, think of it as just a list of things humans need to feel happy. And you've got self-actualization and safety needs in conflict with one another. So I asked this gentleman if he could think of a strategy that would meet his self-actualization needs and also meet her needs for safety and security. And it only took about 3 minutes of thinking and talking with a partner. And he came back and he said, look, well, first of all, the first thought was that I could get a smaller boat. But I really didn't want to do that. And then I realized that what I could do is I've been sailing for a long time. I could offer sailing lessons at my yacht club to some of the teenagers that are new at it there. And by doing this, I would not only offset the cost of my boat, but I would get the added benefit of giving back to my community, feeling like I'm giving to the next generation. And so in this way, he would be able to take the money from the lessons and put that toward his boat so that they could save the money that he was currently spending. So her safety needs are met, his self-actualization needs are met. And then there's even an added bonus of he's giving to his community and he's got that sense of self-esteem and giving back. And so his self-actualization needs are actually amplified. And so everyone's utility goes up because we found a strategy that maximized well-being. We didn't focus on the numbers first, we focused on the needs first, and then you find a way to get the numbers to support the needs. So this is a simple way of flipping our thoughts here. Instead of starting with the numbers, we start with the needs. And so by thinking through, like, what is utility? Utility, by its very definition, involves emotions. Emotions are in every financial trade-off, or at least in all the really big ones. Emotions are very present, and we need to give them the respect that they deserve as information about whether or not our needs are getting met, our deep, fundamental human needs. Numbers do not trump fundamental human needs. We listen for emotional information in the stories that clients drop, in the little messages that the little nuggets of beliefs, and if they start to talk about money in terms of power or success, you take that in and you go, okay, then this person may be using financial strategies to meet their self-actualization or their esteem needs, because they associate money with esteem and power. And so therefore their esteem needs, they're going to think about those using financial trade-offs there. And you coach the mindset, you coach them based on focusing on their needs first and then getting their numbers to support their needs. And then when you hand someone a plan and you say, here is your financial plan, they are much more likely to act on that plan, because all of their needs, all of their deep human needs have already been recognized and are woven into that plan. And so therefore, it's less about handing them numbers and hoping that their emotions line up with it. You're handing them a plan that gives them financial utility and emotional utility on top of it. And that is a plan that people will be able to take and stick with and start to actually actualize. So thank you for your time here. I hope that this way of thinking can help you just change your listening and maybe your conversations in a small but meaningful way. Like I said, it's very simple. It's not necessarily easy, but a lot of things that are really worth doing are very much like that. So thank you, and I'll turn it over now for Q&A.
Thank you very much, Sarah. That was riveting stuff. Especially enjoyed that last case study, which I think all those listening will be able to utilise in life and in their practices. We've got a number of questions, which is excellent. I'd like to start with how do you manage client emotions when the trade-off is not in their best financial interest?
It's a really good question. So it makes me think immediately of an advisor I spoke to who had a client who really loved having girls' nights at the casino, and would call them up and say, "Oh, I was a bad girl. I, dropped $30,000." And the thing about that is understanding for her what are the needs that she's meeting when she's doing that. She's meeting some social needs. She's meeting maybe some self-actualization needs, but recognizing that the financial strategy is a legitimate attempt to meet emotional needs. And so I think the first thing that we've got to do when people have really self-sabotaging financial behaviors is to understand that while they may be sabotaging some needs, they are still meeting other needs. And so really recognizing and talking about the needs that they're meeting, that can help open the door. Because if you just talk about the needs that they're threatening first, without acknowledging the needs that they're meeting, then these needs over here are going to feel threatened. Because if you're talking about, well, but you need to save that, you need to be doing this with your money, then all they're going to be thinking about is, but I have to have my girls' nights. I have to be able to she likes to be the one that buys the drinks. She likes to be the hostess, the one that creates this sense of adventure and fun for her and all her friends. And so by getting your client to talk about, think about the guy talking about the sun on his face and the wind in his hair, and getting her to talk about how she feels when she's out there, providing these girls' nights for her and her friends. What are the things that why is she doing this? There is a legitimate reason why she's doing this. And then again, asking, okay, now that you've recognized the needs that their meeting, and you've given them the respect and the space to say, wow, that's a legitimate need. May not be a legitimate expense, but it's a legitimate need. And so we've got that out on the table now. We're going to make sure that no matter what financial strategy we come up with, those needs get met. Now the person's going to be able to relax a little bit and be open to saying, okay, now let's talk about the needs that you didn't meet. Let's talk about the needs that are not getting met when you take this amount of money and put it over here toward these needs. Now, remember, we're still going to meet these needs, but let's just talk for a moment about the needs that are not getting met. And then you can talk about safety. You can talk about, let's get the emotions of what would it be like if you actually lost that money, because if you had to do without, whether their strategy is to speculate on meme stocks to get their need for adventure and FOMO met, or going to the casino, same thing. But the point is that you talk about the needs that they're meeting, then you talk about the needs that they're not meeting and get them to emotionally connect with those needs. And then when you've got those, you can say, okay, now let's try to find a strategy where we can meet both sets of needs, where you've got your security met, but you're having fun. So in the case of the woman who goes to the casino, it might be setting a casino budget and trying 1 month to meet that budget and see if she can do it. See if she's able to do it, and give her a budget that allows her to still meet her security needs, but can still have fun. Otherwise, it might be if she can't handle herself at the casino and not drop thousands, then you may need to come back and say, okay, let's try to think of other ways without the casino. Can we brainstorm ways that you and your friends can go out and have a great time within this budget? But it's got to be something that she loves. And so the thing is that you, as the coach, you can help them recognize the needs that they need to meet, and help them and say, okay, let's think of some strategies. But it shouldn't be you offering strategies, because if their eyes don't light up, if they're not excited about it, they're not going to do it. And so even if you do offer a strategy, if they go, okay, then it's not a good enough strategy. They need to be really excited about it. So you'll know when you get to a strategy that meets both sets of needs, because they're going to be really excited about trying this new method out. And so it's a little bit of a massaging, but what you've got to do is give airtime to both the needs they're meeting, the needs they're not meeting, and then have a conversation about how can we do both? How can we find a strategy where both of these things are met?
Thank you, Sarah. That's a very good response. Thank you. We've got quite a few questions to get through, so we'll pick one or two quick ones to try and shoot through. Are there leading questions you would suggest that help clients open up about their goals and ambitions, especially when they come to advisors often expecting investment advice?
Yeah, I think that one really good one is, what does the good life mean to you? And just listen. You're going to get so much information from that. Another one might be, one I like is just finish the sentence, money is blank. And, some people say, well, money is security. And now you've got someone who's probably a little bit risk averse, and maybe they're probably really good at saving, but you might have to push them a little bit toward the investment side of things. If, on the other hand, if they say money is freedom, now you might have a spender on your hands. So you'll learn a lot just by getting that one-word response to money is. Those are two that I like to use. If you get the sense that someone is a little bit maybe not comfortable talking about money, another good one would be, just tell me about money growing up. What was your financial experience growing up? And then you'll get their whole financial life story, and you're going to hear a lot of emotional information in there.
Thank you, Sarah. And the very last question was, it was actually one that a lot of advisors do bring up quite often is, how do you encourage clients to spend?
Yeah, that's a big one, because when money is, especially if you're not earning anymore, your security needs are going to be very, very strong in your emotional makeup. And so you're going to want to know that you have your security needs met. I think that there is a really good approach in using mental accounting to help. So you say, well, look, here's the amount of money that we have set aside to make sure that your needs, your lifestyle needs, are met for the rest of your life. You are secure, and letting them know, like, this is more than enough to meet your security needs. Now here is the rest, and I don't mean you need to spend all of it. How about just a little bit? How about we just plan one vacation and dip your toe into spending and start to experience that, you know what, you're still going to be okay on the other side. So I think a lot of it is getting them to just try a little bit and see that the world doesn't fall apart. But the other thing is, I think that, you know, a lot of people talk about this, like, well, how do I get them to spend? If they want to feel secure, and if having money in the bank makes them feel secure, I'm not sure that they need to spend. And with some people, there's so much anxiety that it's lowering their quality of life. And in that case, what I would say is, most likely what it is that they're looking into the future. They're long-term thinkers. They are, but they're what-ifing. They're catastrophizing. Well, what if the market goes down? Well, what if this happens? Well, what if that happens? And if you're a what-ifer, or the worried wealthy, then there is no number that's going to make you feel safe. And at that point, what you need to do is, what's really happening is that they probably don't feel fully in control of they feel vulnerable. They feel like they're worried of all the things that could go wrong. And so helping them to talk through really realistically, okay, let's take that what if. What if the market completely crashed? What if it did? Let's run the numbers. Let's see what happens if the market completely crashed. What would happen to your portfolio? And then let's talk about how you would do. What happens, you know, so you take the what if and you help them turn it into a so what. You help them understand that even if that worst case scenario happened, their life would go on and they would still have all the things that they need in order to thrive as people.
Wonderful.
Yeah.
Thank you so much, Sarah. That was a great discussion. We could go on all long into the night discussing behavioural science and our clients. So I really appreciate your time. Really appreciate you getting up early. And I'd like to thank you very much, Sarah. And thank you to everyone, and enjoy the rest of the conference today. Thank you very much.
So that's a wrap for the main sessions today, and thank you for bearing with us with a few of the technical difficulties we had a bit earlier on. So what's in store from here? At 1:20, there's a session led by Morningstar's Head of Multi-Asset, Mike Coop. You can join that session at 1:20 by following the Morningstar booth, the tab there on your navigation system. Throughout the rest of the afternoon, whether it be workshops you're looking to attend or meet the manager sessions, you can follow those tabs too and plan out your agenda for the rest of the day. Now, for those who have got a big appointment at, say, 10 to 5, 5 to 5 for the big match tonight, all that finishes in plenty of time for you to hopefully watch England get a result today. And we're kicking off tomorrow at 9 o'clock, and we look forward to seeing you back then tomorrow morning.